Okay, I declare open this public hearing of the Senate Standing Committee on Finance and Public Administration. We've had referred to us by the Senate the provisions of the Taxation Deficit Reduction Bill number 1, which relate to the taxation treatment of credit unions. And I emphasise that this wasn't referred under the selection of bills process of the Senate, but by a direct motion in the chamber by Senator Hill, setting out 7 specific terms of reference for us to deal with. And our requirement is to report back to the Senate on Monday week, the 18th of October. The committee, of course, will prepare its report dealing with those terms of reference during next week. As far as the time program is concerned, if we have not finished by 12, we'll need to adjourn and resume at 1:30. But I would have thought that despite the large number of potential witnesses, we have a chance of finishing by 12. The plan is to hear from the Minister representing the Treasurer, Senator Bob McMullen, and Treasury officials, representatives of the credit union movement, representatives from the Building Society peak body, and 2 individuals, Vince Martin and Terry O'Dwyer. And I would make the point that 2 of our witnesses today have past political associations, in Vince Martin as a former member of the House of Representatives, and Mr Ahern from Queensland. So a particular welcome on those grounds. We've received written submissions from all the various organisations concerned and individuals, as well as several other submissions, and I propose that the committee now authorise the publication of these submissions and their printing in a separate volume of the Hansard. There being no objection, that is so ordered. Now I would like to emphasise that the witnesses should assume that the committee has read their submissions, and especially given the time pressures under which we're operating, when I invite you to give your opening presentation, I would suggest that you make that assumption that the submission has been read, and we just invite brief comments speaking to the submission. And as far as time is concerned, I would want to see some sort of balance, if you like, between the credit union groups and the Building Society group, recognising that the credit unions have a substantial peak body and 2 other representative bodies who represent the credit unions. Whereas, as I understand it, the Building Society organisations have 1 peak body. And after hearing from each of the witnesses, I suggest we just have a brief period of any clarifying questions on the submissions or the initial presentation, but hold back any other questions until we've heard from all groups. And after we've heard from all groups, I'll invite the Minister and Treasury again to respond, and then we'll open it up to overall questions in the hope of clarifying the terms of reference. So I'd invite the Minister to make any opening remarks that he wishes.
Well, thank you, Mr Chairman. Really, I think your comments about the timing and the appropriateness of expanding or reiterating those things which are already on the record are appropriate. The government is the body here that's had the most opportunity to put our case on the record. We had the budget speech, the Treasurer's made a submission to the committee. Our position is the known one that's stated in the legislation. I think the importance of at least this opening part of the hearing is to give those who wish to respond a chance to put their views on the record. So I simply say that the government has put its views on the record in the documentation surrounding the budget and in the Treasurer's submission of yesterday's date about these matters, and all I would be doing would be reiterating things that are on the public record. So I think the most appropriate thing is for us to listen to the points people have to raise, and then we'll do our response later, Mr Chairman.
Okay, thank you. Well, in that case, is there anything you want anybody from Treasury to say at this stage? Right. Well, in that case, I invite the representative from the Credit Union Services Corporation Australia Limited to address the committee.
Thank you, Chairman. My name is Graham Lachlan. My colleague David Taylor and I appear on behalf of Credit Union Services Corporation Australia Limited, which is the peak national credit union body, representing 83% of Australia's 329 credit unions, their 3.1 million members, and those members' savings of $12 billion. In a wider sense, however, given the critical importance of this issue to the future of credit unions, I think it's fair to say that both David and I, and our other colleagues from the credit union movement who are here today, represent the interests of all credit unions, regardless of their industry affiliation. I should say at the outset that credit unions are opposed to the provisions of the bill that propose to eliminate their partial tax exemption. An exemption which until now has secured bipartisan support for 20 years, and for which bipartisan support was reaffirmed only last year by the report on banking and deregulation of the House of Representatives Standing Committee on Finance and Public Administration, the Martin Report. It is a tax exemption, moreover, which adopted international best practice when it was introduced in 1974 and which still stands today on the taxation statutes of the UK and the USA. From the government's point of view, we are not talking about a lot of money. The effect of withdrawing the measure on the government's 4-year deficit reduction strategy will be a negligible $55 million. To put that into some perspective, we are talking about a revenue item that over 4 years will raise less money than the saving that would be achieved if the income tax cuts proposed were postponed by 4 days. But the effects upon credit unions, their members and the wider community will not be so minor. They will be both serious and regressive. The credit union tax proposal will reduce substantially the capacity of credit unions to provide social benefits in the form of low-cost financial services, free financial assistance and counselling, volunteer involvement and community development. It will put at risk the continued provision of what the Martin Committee called lifeline financial services to the battlers, the indigent and increasingly the isolated in rural centres that are being evacuated in their score by banks. It will lead to increased costs for all our 3 million members, not least being those on low incomes and welfare who form a major and growing component of our membership. These are serious claims. They are not extravagant. They are thoroughly documented in our submission. The reason they will occur is because the 1/3 of credit union income that will be forfeit annually in tax under this proposal will translate into 1/3 less in the annual capital growth of credit unions. And the reason in turn why this will happen is that credit unions' retained earnings after tax are their only source of capital. Reduced capital growth will produce its own inevitable knock-on effects, the most immediate of which will be the necessity for credit unions to cut costs and generate additional revenues. They will be driven by the need to make greater profits in order to increase their levels of after-tax retained earnings. What this means in practical everyday terms is higher loan rates and charges and fewer services for those in the community who can least afford it. In the longer term, the restraint this tax proposal will impose upon credit unions' capital growth will significantly limit the overall growth of the movement. It will do so because, quite correctly, it is illegal for a credit union to grow its assets faster than they can be supported by the prescribed minimum level of capital. It will thus become increasingly difficult to grow at the rate needed to meet rising costs, or to fund the levels of products and services, research and development that will be needed if credit unions are to remain relevant to their members' needs. This prospect of capital starvation is so serious that we think it likely that credit unions will be forced to consider the issuance of permanent share capital. If and when they do, they will cease to be credit unions as we now know them. They won't be mutually owned cooperative institutions, limited in membership by their common bonds, and promoting the democratic participation, the economic and the social welfare of their members. They will instead be forced to adopt the same objective of maximising profit in order to service stockholders as any other Main Street financial institution. Mr Chairman, it is plain from the explanatory memorandum accompanying the bill that none of these outcomes was considered by the government. The government focused instead on claiming justification for the change rather than forecasting the effects of the change. And the claim to justification is simply this. The credit union tax exemption is no longer necessary, the government says, first, because deregulation of the financial system has rendered it redundant, and second, because its repeal is required on the grounds of tax equity and competitive neutrality. Two final points, if I may, Mr Chairman, and the first is this. Judged against the reasons for its introduction, which remain unaffected by deregulation, the justification for Section 23G of the Income Tax Assessment Act is as contemporary today as it was 20 years ago. It is not obsolete, it has not been rendered redundant. Finally, the government's proposal will achieve neither tax neutrality nor a level playing field. On the contrary, and as we make the case in our documented submission, it will compound the many competitive disadvantages already faced by credit unions. Thank you, Chairman.
Thank you, Mr Lachlan. I now invite Mr Hearn from the National Credit Union Association Incorporated to address the committee.
Thank you very much, Senator. Thank you, first of all, for reminding me of my political associations in the past.
You may not thank us for that, but
yes, when I wake up every morning, I'm rather gleeful that I've left all that. But you've reminded us today. I'd assure you that in my roles now, I'm politically neutral and do not become involved in any political process at all, and so that needs to be said. It's unfortunate, Senators, that this matter is being addressed in the climate that it is now. I know that's the imperative of the day, but we're in a situation where a very serious historical issue is being addressed, and unfortunately we've got to determine whether John Dawkins loses face, whether Bob McMullen wins or loses, and there are TV cameras outside ready to paint up the score. Now, unfortunately, this issue is a very complex matter. It's a matter of intensely competing interests, and given the rich history around the world of the cooperative movement, it really deserves much more careful time consideration than that. It's not something that will impact on this budget, but there is time to give it further consideration by independent parties, and really the credit union's 3 million members, given their international linkages and all of that history, they really deserve that, and that's the primary point that I wish to make. I don't know whether you can do it. I'd also say to you, as a politician of 22 years standing, and I went up to become the regulator of non-bank institutions in my state for a couple of years, so I've been across the board looking at cooperatives and others from time to time. I would ask you as senators to put up the flag of caution when an interest group comes at you and says that they're being subjected to unfair competition, and you rush in and make a change. You find out later on, when it's all too late, that there are other agendas and other consequences which were not foreseen. And I say that quite definitely with rich experience, which I'll readily relate to you given time. At the outset, it's interesting to study the history of this industry around the world and the battles that it's had. At the end of the day, in the United States of America, there are 13,200 credit unions. They've got $280 billion in assets, and they're not taxed. They're not savings and loans. And in Australia, there's a view that, oh, well, the credit unions in the States are the savings and loans. That's not so. They're not taxed. In the United Kingdom, they're not taxed. So at the end of the day, we're venturing into something here that historically around the world is very different. Now, it came up from grassroots, this cooperative movement. It was all based on not profit alone, but some emphasis on service. I was a member of a cooperative when I was in my teens. They have won their place in the sun by the efforts of elected people down history. Elected people like you. The cooperatives have always been opposed by the corporate people. We've always said, what are these guys getting special consideration for? Get rid of them. That's the history everywhere around the world. But the politicians have said no, give them a go. The regulators have always been unhappy with it, down history, here and elsewhere, in North America particularly. It is much more comfortable for regulators for things to be much larger and more manageable, but people who are elected have listened to the cooperative movement and said the ethos of service and cooperation and sharing in manufacture, processing, selling, credit sharing is all right, and we ought to give them a go. As I said, the bureaucrats, and I don't wish to, I'm speaking generally, I'm not relating to anyone here, I don't want any physical violence during lunch or anything like that, but the reality is that I've had bureaucrats around me, and it is much more comfortable for them if the institutions are much bigger. They would be much more preferable. One of them actually said to me in Queensland, the day will come when there's no NBFIs, and that will be good for Australia. These fellas are in the main small. They're 1.5% of the business in Australia, but they're small communities, they're the BHP steel workers, they're the Victorian teachers, they're the Qantas employees and so on. And if you force them into, which will come from this, into a capital raising exercise, you pull the stomach out of the cooperative movement and it will eventually destroy itself, totally. So it's a threshold, serious, fundamental issue. It runs counter to what AFIC's doing. AFIC's been good. Everybody has digested it well, and David Knott's done an excellent job. But now you're saying all the capital adequacy business that they've fought hard to build up is now going to be taxed, all the capacity to do that. And so it'll make it harder, and they'll run down their surpluses. They won't do what AFIC has been asking them to do. Now, I want to finish on this point because you asked us to restrict it to 5 minutes, and that's hard for me. But I want to ask you as elected senators... Sorry?
We'll be tolerant if you've got additional matters to raise.
Just one last issue to...
Not so early in the day we won't do that.
...to raise is this issue of the building society. So I've been a strong supporter of building societies down through the years, and they're entitled to have their say. But they are competitors out there in the marketplace at the present time, and take care when a substantial section of industry comes to you and tells you to change the rules on their competitor, because downstream you'll see some sequelae you didn't foresee at the time. And there'll be no doubt about that as they come forward in your discussions now. They are very much a vested group that come before your committee today. The old credit union person in Australia is a dinkum Aussie out there that's cooperated in the past, done their own thing and saved governments a hell of a lot of trouble across the board. And they're entitled to be heard, and in the past their saviour has been the elected members of legislatures here and around the world. They wouldn't be there if it weren't for you people. And so with your support they can continue. If you let the bureaucrats have their say, they'll be gone. And this instance will sound the death knell, ultimately, of the credit union industry. Thank you.
Thank you, Mr Hearn. Now the Independent Association of Credit Unions Limited.
Mr Chairman, my name is James McCall. I'm here with my colleague Mr Halliday to represent the views of the Independent Association of Credit Unions. Some 46 credit unions we represent directly and by affiliation along the eastern seaboard of this country. This issue is of enormous concern to our members, and we support fully the views put forward by our colleagues from CUSCL and from the National Association of Credit Unions as presented to you here this morning and in their written submissions. The members of our association tend to see this process to fall into two areas. First of all, what we consider to be quite a legitimate motivation of government in introducing the legislation, but while we won't impugn the motive of government in introducing this bill, we feel that it emanates from a misunderstanding by Treasury on the unique differences of a credit union and the need to treat credit unions differently to other types of corporate structures in the financial sector. In terms of the lobbying process that's taken place and the views of other members of the financial community, there's a view prevalent amongst our membership that this is simply an attempt by those groups to prop up an ailing banking system and an ailing building society system by annihilating the one deposit-taking section of the financial institution community that offers any real competition to the banks and to building societies in the field of domestic finance. The solution to the problems of those institutions is to improve their modus operandi rather than endeavouring to eliminate legitimate competition by promoting legislation that would make their credit union competitors less able to meet their member customer needs. The strategy of the banks and building societies is not a legitimate use of the taxation laws. The essential difference in the structure of a credit union to banks and to building societies lays in the nature of its shareholding. In a credit union, like any genuine cooperative, shares in a credit union are always only ever worth par value. In other words, when a credit union retains earnings, this previously non-tax earnings, there is no increase in the proprietary ownership, if you like, of the members of the credit union. If a member of a credit union leaves the credit union, there is no entitlement by that departing member to any share in that capital base. In a corporation, in the case of a bank, in a case of these building societies that have permanent shares, when they retain earnings, their capital base increases. All things being equal, those people, shareholders, are able to take that piece of paper along to a stock exchange and to trade that in for a profit. They have an immediate financial advantage that they can cash in. When a credit union retains earnings and a capital base expands, there is no immediate and we would suggest no long-term cash benefit in the retention of those earnings. As such, credit unions are genuine cooperatives, genuine mutual organisations, and as such are entitled to the benefits of the long-standing tradition of traditional treatment of mutual societies in having their mutual activities remain free of taxation. The Section 23G provisions recognise that. Building societies, over 67% of building societies with assets that total 83% of the total building society assets have permanent shareholders. There are some building societies that don't have permanent shares, but nevertheless those building societies have an entitlement to hold permanent shares. A building society is quite a different type of institution to a credit union, quite uniquely different from a credit union. We have representatives of various building societies here today. Bendigo Building Society is an example of a society that does a great deal of its business with the public, with people who are not members of the building society. We have Home Building Society from Western Australia, which is substantially a privately owned building society, just as Pyramid was a privately owned building society. Building societies are really quite different. To have blanket taxation laws or to try and create I think the in word is harmony in the financial institution sector by imposing a blanket legislation is not only undesirable but totally inequitable. The building societies and banks, as we've stated previously, because of their need to raise capital through the issue of shares, of permanent shares, of tradable shares, there's been a drive by building societies to increase their capital base, to increase their profitability by increasing and increase their number of shares. It's been that drive for profit that led to that catastrophe that occurred with Pyramid. There has never been a catastrophe like that in the credit union movement. If this bill is passed, the probability of such a catastrophe occurring will increase dramatically. If credit unions are forced to go into the marketplace and raise that type of permanent capital, they will lose their cooperative status, they will walk away from the cooperative sector, and they will become in much the same position as these building societies and in fact banks, where there's an ever-increasing drive by the owners of shares, pressure by the owners of shares to increase the profitability of the institution, that is to increase the return to shareholders that will drive these institutions into the same fields of error that the banking system and the building society have been prone to over the last decade. The credit unions at the moment are able to operate under the mutuality principle, and I would argue that at a time when the Commonwealth Government is extremely concerned about the decreasing level of savings of ordinary Australians, it seems to be very, very unwise to endeavour to curtail the activities of those societies that are most vigorous of all the financial institutions in encouraging frugality and savings amongst ordinary Australians. That's the whole thrust of the credit union movement, the whole drive and motivation of that credit union movement. As my colleague Mr O'Hearn mentioned a little while ago, there are no direct revenue implications for the government in the coming financial year. This bill, the passage of this bill or its failure to pass, will not affect the government's strategy in this financial year. And as a very last alternative, if the Senate has any reservations about hitting this bill on the head, we feel that in fairness to our 3.1 million members, it would be appropriate to withdraw the bill at this stage and at least allow a consultative process to take place over the next 6 or 7 months prior to any further advancement of the legislation, so that the government and members of the Senate that are not members of the government have further opportunity to examine this matter very, very fully. It's an extremely important matter, Mr Chairman, and it will affect the lives of thousands of people. Thank you.
Thank you, Mr McCall. Now I invite the Australian Association of Permanent Building Societies to present their case.
Thank you, Mr Chairman. My name is Peter Jack, and we'd like to have a few minutes from each of 3 or 4 of us to counter the 3 we've had. If we can start off with Mr Jim Larkey, who's Executive Director of the Association.
Thank you very much, Senator, and members of the committee. Our representation today is very much reflected by the people who are here, obviously, and they are people who are actually running building societies. They are people who are the managers of societies in the regions, and they are people who for many years have been making loans and taking deposits and attempting to balance the books. And I think it's significant that the representation around the table from the credit union movement, whilst very distinguished and very skillful, does not include anyone who is in the business of making a loan or taking a deposit or as manager of a financial institution. And I think that is important because there's a lot of emotion and there's a lot of red herrings being dragged around Parliament House since the government made its announcement. I think it's very important during today for the committee, if you could turn that on for me, for the committee to winkle out, if we can, the various types of credit unions, the traditional credit unions that as children we knew about, and the credit unions and the modern credit unions of today, which are most effective and most effective in the marketplace. But let me briefly say that our group comes to this meeting today firmly supportive of the government's decision. We do that on 3 basic grounds. Firstly, on the grounds of fairness, because the fairness in relation to the people we serve, and as you can see on that chart, the numbers are not greatly different. So the people who do business with building societies effectively are paying tax. And
This is the chart, just for reference, this is the chart from page 3 of your submission.
Yes, Mr. Chairman.
Thank you.
And those doing business with the credit unions, similar size, they don't pay tax. So there's a very, very significant fairness and discrimination issue. And this government and the Senate ought to be concerned with issues of fairness and equity. Our second ground of support for the government is on a competitive equity issue as between institutions who are very, very similar in many ways and serving similar people. Both the credit unions and ourselves have people working in the branches, at the counters, directors, managers, all working very hard to provide service, to provide competition to the banks and others, and they are motivated and they work hard and they work well. But at the end of the year, when they draw the line on their finances, this group sends a cheque of $50 million to pay for this and to pay for social services, justifiable social services, and when they draw the line, they don't send any tax to anybody. So there's a competitive equity issue which over the 20 years whilst this subsidy has been in place has grown to very, very significant proportions. It wasn't significant in '74 when Mr Martin was in Parliament, but it is very, very significant now, despite what Mr Ahern said. There is a distortive effect also, and that's our third basis for drawing this to your attention. And we believe in the long term there are adverse prudential aspects for the credit union movement. We've also drawn attention to the social justice issues which credit unions have played great play on. We think that social justice issues are best served by the social security system, but we acknowledge, of course, that there are, and I want to wiggle out if we can, those credit unions in the parishes, in the churches, doing what they do. Credit Union Services Corporation, frankly, has engaged in a very intensive and emotive lobbying campaign in the last 3 weeks, and I give them full credit for that. It's been the mother of all campaigns. But they have raised extraneous issues, as they have this morning, which I think need to be closely examined by the committee. Our submission responds to each one of those. And I won't repeat what is in there, but I'm very happy to speak about it. But I do want to also mention to you that the government has been portrayed here as some sort of a nasty group who want to screw down the good guys and the good building societies and the good credit unions. Let me say that both this government now and the previous government have done a number of things to fundamentally improve the competitive position of both credit unions and building societies, and they haven't cost the taxpayer a dollar. So the government, the federal government, is aware, I believe, of our competitive needs to compete with the big banks. And I think they're moving that way, and they certainly have 2 or 3 issues which are current and which the indications are of movement forward. And I refer to the federal government's initiative and support, and indeed Mr Hawke's initiative to get the framework that we now have, the ongoing reform of the payment system, and there are other major issues. In other words, the federal government is assisting us to be competitive with our bank competitors. So, Senators, I will conclude by saying our submission is not opportunist. We have had proposals before the Treasurer of the day for the last 10 years every year. In terms of the substance, it's been suggested that there's not a big subsidy. Its cost and the benefit to the credit unions has been $200+ million in the last 10 years, and if the bullet isn't bitten now, my view is, as they grow, as they will, and they're the leading institutions in terms of growth, the subsidy could be of the order of $500 million plus in the next 10 years. That's my remarks. I would ask for my colleagues to have an opportunity to briefly...
Yes, thank you, Mr Larkey.
Thank you, Mr Chairman. If I might just reiterate on one point, the credit unions made a big issue of the social benefits that they provide, and I can assure you that credit unions are not unique in that area. I believe it's extremely inefficient for us to subsidise credit unions because some of their customers may be disadvantaged. If you look at the top 10 credit unions by size, by far the majority of them are workplace-based, teachers, public servants, Qantas pilots and the like. These are hardly disadvantaged. If in fact they are providing special services to the disadvantaged, then that would be better subsidised directly in an accountable manner by the government writing a cheque and putting it in the expenditure allocation section of the budget. And if they're going to do that, then I see no reason why they shouldn't also do it for banks and building societies when they provide those services. That's really all I had to say on the matter. If I could introduce Peter King from Home Building Society.
Thank you, Senator and Committee. I think it is without doubt that the credit unions are players in the financial system in Australia. And we have seen that system have major restructuring over the past years. And we're seeing further restructuring with the opening of the payment system for credit unions and building societies to play a major part. Now, it is a fact that the credit unions are out there promoting their products and services to gain savings from the households. And they compete directly with building societies and banks. And it is a fact that every day in the papers you can pick up that a credit union is advertising its products. Their products in the marketplace are as competitive as building societies and banks. And it's inequitable that a tax subsidy is paid to the credit unions who are in the marketplace competing with us. I just want to refer to a colleague from the credit unions that mentioned about pyramid and raised the question of the Teachers Credit Society in West Australia, which was the largest credit union in Australia at a time. They gained their growth through advertising to the general public and grew their asset base to a size which became unmanageable. They also provided services to not all the needy, but were providing services to a lot of other well-off people, and those people became the subject of a Royal Commission in West Australia. Now, under the new legislation, under AFIC, those years of the pyramid and the teachers, I'm glad to say, are behind us. But the credit unions are now actively entering into the market of home loans, which has been an area where the building societies have specialised. The credit unions are actively promoting Visa cards. People of the public can walk into a credit union and deposit funds and take loan funds out of a credit union. They are asked to become a member of that credit union in the same way as they're asked to become a member of a building society when they come in and ask for services. So I put to the committee that we are in direct competition with the credit unions, and the current tax subsidy that is given to the credit unions gives them an unfair advantage. Thank you.
Thank you, Mr King. Mr Hunt.
Senators Committee, I've only got a couple of comments to make. Bendigo was referred to in this conversation, but I'll tend to avoid getting into that discussion. From my point of view, credit unions, like building societies, provide an excellent service and a real alternative to the banking system for the majority of households in Australia. And that's evidenced by the number of members and depositors and borrowers from the non-bank sector. So I think they provide a quality service. In our case, we referred to the fact that building societies were quite different. Well, frankly, the building societies in operation today are regional, are community-based, and do contribute substantial support to the community structures. And that can be evidenced in virtually every community in which a building society operates. So much like the credit unions, there is in fact a substantial amount of effort goes back into putting something back into the community that supports us in terms of our business. The clients are very similar, despite what was said. The clients are very similar. Our organisations support the low-income earners, the people in distress, and in fact we have special centres in a number of building societies that are set up purely to handle the hardship cases in today's recession. So to claim that it's a domain of credit unions is incorrect. We recognise that there are a number of small credit unions that do in fact are of the traditional mould. Very small, like members, helping like members, and they are relatively small. But the credit unions that are out there actively marketing, advertising and promoting their services do run finance shops. They are competition. The major difference in my eyes, because it was referred to about the balance sheet issues, the major difference in my eyes that the building societies have to build a balance sheet with after-tax profits. And sometimes organisations have gone about that differently, but always with after-tax profits. Even dividends paid to permanent shareholders after tax. So I think it's important to recognise that. We are building a balance sheet in a same competitive environment, and we are being successful, despite the comments that perhaps the building societies don't know where they want to go. Well, frankly, I am certain the building society industry knows where it wants to be and in fact provides a real alternative. So that's one key difference. The note about that some issue permanent shares and some don't, I think building societies have a mixture of some who issue permanent shares and raise capital and service that capital in that way. There are others who are cooperatives who basically build their balance sheet purely from retained profits. So there is a wide range of societies, but in the end, all of them building it with after-tax profits. We are forced in our market to ensure maximum efficiency in terms of operation. That says we have to manage our costs. We have to work very hard because we work on similar margins to the banks, and therefore we have to work very hard to gain access to clients. We don't have the advantage. It would make my job very easy if you were to say to me to provide me a no-tax regime for my profit. Make my job very easy to build the balance sheet strength because it takes away the pressure of all the rigours of market. In my view, the clients are very much the same. The organisations are very similar, although maybe they are different in terms of the balance sheet structure. But we are in competition, and we are in competition, in direct head-to-head competition, if you look at the advertising that's being done. I think credit unions provide an excellent service. I don't want to see, the credit union movement taken out of the system, but I don't believe it will be. I believe it just needs a management with a focus to manage the expenses, to manage the costs, and to prioritise the services that they actually deliver to the community. And I really think it's overstated to say the organisations are going to go out of business because they have to actually apply greater management rigour. Thank you.
Thank you, Mr Hunt. Okay, thank you very much indeed. I now invite Vince Martin to address the committee.
Thank you, Mr Chairman. There seems to be a battle developing between the building societies and the credit unions, which I think is very sad. I wondered where some of the pressure had come from. I now know. I think it's worthwhile let's get back to tours, if we may, and have a look at the history of what is now known as the credit union movement. Its formation was back in 1946. There was a Air Force fighter pilot by the name of Kevin Yates, who, having returned from overseas service and having seen credit unions operating in Germany, in Canada, America and the United Kingdom, was really the first to introduce that type of movement into Australia. It was originally known as the Savings and Loans Cooperative, and wasn't until the early 60s, if my memory serves me right, that the terminology was changed to a credit union. I was one of those who, around about that time, was interested in this type of cooperative movement, and I came to know Kevin Yates. I subsequently became very active in the formation of what were then known as savings and loans cooperative societies, subsequently known as credit unions. Around about that time there was another organisation similar to the credit union movement, but probably more at basic parish level within the Catholic Church system, known as the Antigonish movement. They weren't called credit unions, but they were really in-depth, more of a charitable organisation and more dealing with the really financially disadvantaged. I was a member of that movement also. Well, over the years, I can remember back, I used to work in the tax office, but don't hold that against me. And I helped to form a credit union in the tax office. And in those days, I had 5 children, I think, or 5 or 6, and we didn't have a refrigerator, but we had an ice chest. So I bored a hole in the kitchen floor, and the water ran through that. And so I borrowed £300 it was from the income tax. I was one of their first debtors. I borrowed £300 and bought a silent night refrigerator. That to me was luxury. But over the period I became interested in the Credit Union League, and it was formed around about 1966, and I think the first credit union, even under a different name, which was formed was the Universal Credit Union, formed in the middle of Sydney, and it was developed over there, and I'm pleased to say that in the audience today is Mr Tom Kelly, who was one of the founders of that credit union and has done a remarkable job in the credit union movement. The point that I would like to draw out is that from the point of view of our position in Australia with the rest of the world, I know of no other credit union, be it in that name or some other name, who pays tax, because there is a universal feeling with all governments that credit unions as such are set up basically to help the disadvantaged people in the community, which it does. I'm a member of a permanent building society, so I have nothing against them. But they are entirely different. The functions of a credit union are entirely different to the functions of a permanent building society. The credit unions are just not in the marketplace purely to get capital in. The purpose of a credit union, and it's got a Christian outlook. A credit union basically is a Christian outlook. In fact, each credit union meeting that I've ever been at starts with the prayer to St Francis of Assisi. And that's one of the principles of it. I was one of the ones, I'm sorry to be saying I all the time, but the first approaches to the then government were made by the National Credit Union Association. There was what is equivalent to that as the Australian Federation of Credit Union Leagues, and the person concerned was the chief executive officer of that was a man by the name of Dermot Ryan, good Irishman. I assisted him because I was in Parliament at the time, and I used to hammer Mr Whitlam a bit, I must admit, and Frank Crean. I was the chairman of the government economic committee, and through that, I kept hammering at Frank Crean, the then treasurer, and Mr Whitlam, the Prime Minister, gave an undertaking in writing on the 24th of October 1972, a copy of which I have got in writing, and I was present when he had it typed, that if he elected, they would exempt credit unions from income tax, and he kept that promise. In fact, the bill was introduced by Mr Frank Crean, the father of one of our very good ministers in the present government. It was introduced by Frank Cran on the 14th of November 1974, and it's been that way ever since. I saw a little tiny bit in the paper after the last budget that what was going to happen to the credit unions. I didn't believe it at first. I was shocked because I knew what the principles which I had enunciated and many members of the Labor Party had enunciated in regard to credit unions, and we felt, and after speaking to people connected with the party, we all felt that we had been badly let down by the government. And from a political point of view, and I made this statement to the Financial Review when I was down some few weeks ago, I thought then and I think now that for the government to go ahead with this, it is political suicide. I don't want to enter into the financial side of it. My colleagues from the associations have. I think they were very good in what they said. But could I just say this, that I agree with what one of the previous speakers has said. I think it should be withdrawn from the bill to have another look at it and look at it in a different sort of climate and in a different light than we are looking at it today.
Thank you very much. I now invite Terry O'Dwyer to address the committee.
Thank you, Senator, Committee, Minister. I attend before this committee as the managing partner of Kendall's KBM. We're a chartered accounting practice which, with colleagues and associates around Australia, audit and provide accounting services to about 80% by value of the national credit union industry. In 1992, I served as a member of the Australian Financial Institutions Commission Steering Committee, which developed the prudential standards that now control both building societies and credit unions under the Financial Institutions Code. I'm a director of Ipswich and Westmoreton Building Society, which on Wednesday of this week successfully floated on the Australian Stock Exchange. In Queensland, I'm a member of the Institute of Chartered Accountants, Australian Securities Commission Liaison Committee, and of their Professional Standards Committee. I state those matters by way of background and advise that I am here representing the views of my practice and not those of any building society, credit union or any other group within the industry. I must say to you that we as a practice regard the taxing of loan interest received by a credit union from a credit union member as a denial of long-established taxation principles. It is to this matter I will address my opening remarks. In 1974, the government and the opposition of the day concurred that the various High Court actions by credit unions wherein they sought to be recognised as mutual bodies had failed. Not failed on the substantive tests, but rather on a technicality, that different classes of members were produced by the natural fact that not all members were borrowers. However, it was understood that credit unions acted in an agency role for members who would be forced into a situation where income made from themselves would be taxed, were the broad principles of the mutuality concept not allowed. The retention of this principle was deemed important. Indeed, if it were denied in its broad reach, then many internal transactions of families and individuals would be taxed. Quite properly, the government, with the support of the whole Parliament, determined to confirm as exempt from taxation only that part of the income of a credit union which was generated in its role as an internal agent. What has changed now which should have this proper principle overturned? I can think only of 4 issues. The first of these we've seen some demonstration of, I perceive today. But there is no doubt that certain interest groups who could not in 1974, and certainly cannot now, satisfy the broad principles of mutuality, have become more strident in their cry for a level playing field, when in fact, not only do they not play on the field, but they don't even play the same game. Secondly, the AFIC legislation has been introduced relatively recently. and it gives the appearance of a single code applying to a single group comprising building societies and credit unions. Without the detail of the code, the current government's action might seem to have some force. The reality, however, is the single code allows for two very distinct groups, one mutual, credit unions, and the other not. Their different characteristics are set out in the code. I don't plan to go into those, but let me say to you that not only are those which are set out items which separate the two groups, but there are others which have a significant bearing. One of those, for instance, is the fact that Tier 1 capital for capital adequacy requirements provides building societies with a greater ease of obtaining their capital adequacy because of the risk weighting of home loans. In addition to that, they do not have to, in the calculation of capital adequacy, come to the same level in the first tranche. Perhaps as a third alternative, one perspective might be that credit unions have made too large surpluses in recent years. Perhaps this view has produced a temptation to put the expedient of revenue demand over proper principle. Perhaps those charged with the responsibility of understanding the complexity have not understood that in the last 4 years, all credit unions have had to uncharacteristically garner larger retained earnings. They have had to do this to ensure that they satisfy the foreshadowed capital adequacy requirements of the AFIC Code. This because they, unlike building societies, are prevented by law from seeking or obtaining capital from the equities market. They cannot and do not sell their stock as building societies can. As an aside, might I say that one effect of the introduction of the AFIC Code has been the right back to surplus of the statutory provisions for doubtful debts of many credit unions. This has raised surpluses in the years to June 30, 1993 in a manner which is somewhat artificial, and I suspect that this has not been adequately factored into the figures of those who have a view that the past year's profits of credit unions are more than are reasonable. Finally, it might be that the government and the opposition collectively got it wrong in 1974. In truth, that can be the only possible logical reason why there should be a change now. Technically, our political leaders in unison did not get it wrong when they introduced Section 23G to the Income Tax Assessment Act, nor did they get it wrong then on social or moral grounds, although I will say nothing more about those. The simple fact is that the basis for action then was correct. Nothing has changed except the political opportunity created by the introduction of the AFIC Code to attempt to explain away the overturning of a proper tax principle. The building society industry has willingly played a part in developing confusion because ultimately they hope to destroy a competitor. Mr Chairman, I thank you for the opportunity to present the views of the practice. I ask that the committee reject this budget expedient, which is without a fair and proper basis. Thank you.
Thank you very much. Now, I've had a message from the audience saying there's a long-standing director of a small parish credit union present with 30 years' expertise. Would it be possible for him to speak? I suspect that's in response to the challenge from the building societies that the only credit union witnesses were non-operators. Is it the wish of the committee to give this person a couple of minutes to address the committee? Yep. That's so ordered. Perhaps if you just take Mr Taylor's place for a couple of minutes and or Mr O'Dwyer's place.
Mr Chairman and Senators, my name is Greg O'Dowd. I'm Director of Barden Parish Credit Union, and I think that you have to realise that the extent of community service which is available for parish credit unions, the tragedy in fact is they haven't caught on more often in the community, and this may be the death blow that puts an end to them. There are three types of credit unions the committee should be aware of. There's the big industrials, and they're the fellows who have the teachers and the Qantas pilots. They're only one form of credit unions. There are other community credit unions that form in towns, such as Bay Desert in Queensland has a good one, and there's Capricornia in Rockhampton. And then we have a series of parish credit unions throughout Australia. And these people unite a parish, they unite a community. We had a case in the last month or so where, because of my credit union connection and association with Barden, a person brought to me a case of a brain-injured child. And this came from the Friends of Brain-Injured Children in Queensland, who were referred by the Royal Brisbane Hospital. Because of my credit union connections, I was able to sort of contact members and say, would you come onto a group to look after a brain-injured child? Within 1 month, less than a month, we had 30 people on a roster attending that house twice daily to move an innocent little child's hands and arms. And that was there because I had a credit union connection in the community. I've since had another request to help a family with 2 paraplegic children, and I'm currently in the course of setting this up through the community involvement that a parish credit union can give. Unfortunately, it is too rare in the community. Now, as for tax and things, the money we use, we've set up a trust, and we've put that into the Barden Parish Trust. We get applications for loans from people who can't afford a loan, and we come under the AFIC legislation. We have to meet the requirements. So we came over that by setting up a trust for the people, some of whom in the community can't pay for their funerals. We make sure they have a decent funeral. We give families money so they can have the education of their choice. And it's only a small one, but we come up with a couple of payments every year that makes the difference in well-off or not so well-off families being able to meet a reasonable requirement for their family education. Now, if this goes through, I can see the end of this because the money we can afford to put in that will go to the Commonwealth Government. And I'm quite concerned that it will mean the death knell of parish credit unions because they're going to say, well, the government gets the tax, let the government do all this. And it's going to cause great distress to a number of needy families that the local community can meet. So I'd just like to make a point. There's more than one sort of credit unions. We're not all the high flyers, the building societies are flying about. There's a lot of credit unions around Victoria and in other states, but not enough of them. If this goes through, you will kill it. If we have a chance, we will build on it. And the Australian community will be a lot more better for that. And this is why the cooperative moves. I can tell a story how the effect of this. And this is credit union history throughout the world. In the British Honduras, there was a British governor there who was appalled at the livelihood of the natives and their inability to increase their life. This was Father Marion Gainey, a Jesuit priest, was put there. He went around all the villages and said, all right, I want you to save a fish each this week and we'll sell it. And he kept selling it. He got a little pool and he got them a net, a fishing net. Then he went around the village and got them nets. They increased the fish take and they sold it. Then he said, now you've got some nets, you need boats to go with it. And he went right around the British Honduras and lifted the lifestyle immeasurably. Now, the British governor got transferred to Samoa, and he said to the world leader of Jesuits, that man's done his role over there, we need him in Samoa and Fiji. And Father Marion Gainey was transferred there and did the same. And to his honour, they now have the Marion Gainey Credit Union School to teach cooperatives and credit unions in Fiji. That man was brought to Australia by the credit union movement to tell us about it. And he's there to saying it's not the money that counts, it's the people. And that's what it's all about, the dedicated credit union movement. Unfortunately, the high flyers take the glamour off what the rest of us do. I'm just asking you to remember the main game. There's a lot of people out there to be helped, and we can do it better than anyone else. Thank you.
Thank you, Mr. Haddad. Now, Minister, would you like to respond to the evidence we've received so far?
Well, I don't want to say much, Mr. Chairman, because I think most of it has been reiteration of known positions. That's not as by way of criticism. That would be remarkable if it wasn't so, if people came along here and said something other than what was the case for their interest. But I do want to say some things, and of course it was a particularly difficult piece of advocacy to follow, but let me nevertheless seek to do it. Briefly, the lobbying effort that has been undertaken in this matter has been a very substantial one and an efficient one. But as often occurs when you get good professional lobbyists running a campaign, what you find is the interests of the wealthy are shielded behind the arguments for the poor. There's a very unique situation to find the rich conscripting the poor to represent their interests in a political debate. We've got the situation where it's true that there are a significant number of small credit unions. There are different statistics around, but if there are a number of credit unions with assets of less than $1 million, there are in the order of 50. But with assets of more than $100 million, there are 20 or 30. There are different figures about, but let's take the lower number and say 20. So we have to be very careful that in a proper concern for the local community activity of concerned citizens, whether through their parish or otherwise, whether in exercising a proper concern for that, we do not, at the end of the spectrum where the money and the commercial activity and the competition is, that we don't wind up giving an unfair benefit to organisations that don't reflect those same characteristics. And like many people here, I've been a member of a credit union and had the pleasant opportunity to, as a union official, introduce all my members into a credit union from which they got substantial benefit. But I also saw that credit union then amalgamate with several others and was surprised, this is when I was in Western Australia, and was surprised when walking down the street of some other cities in Australia to see offices of that credit union in the main street. And it couldn't have been any of the members that were there when I joined it, because they by definition all lived in Western Australia, because that's what it was. Now, I'm not averse to it growing. If it succeeded, it was because it was providing services to people. It's entitled to do that. It's not a criticism, but it certainly distinguishes it from a parish credit union or a small mutual organisation. So I think we have to distinguish there. And when you look at how the tax system is going to work on credit unions, and when you understand as the committee would, it's the basic arithmetic of the tax system, that when you're drawn into the tax net and have to pay tax on your interest income, you can offset against that the costs incurred in earning that interest income. The tax imposed on small credit unions with assets of less than $1 million, exercise your imagination. How could it be more than almost nothing? There's not going to be, and the data makes it clear. And our submission, the Treasury submission, is the simplest way of saying it, that there are about 30% of credit unions, there's fewer than 100, earning 85% of the profits. So that's where the tax revenue is going to be. It's not going to be from the credit unions with $1 million or less of assets. I mean, as a matter of arithmetic, that must inevitably be so. And the budget is not going to be made or broken by any of the small measures that come up in a package. Certainly not this budget, because this is not a revenue measure for this year. You don't need to smile. I wasn't saying this budget's got other problems. This is no addition to it, because I don't actually think that's the case. But in future years, you get the cumulative effect of saying that $45 million doesn't mean much for revenue. That $70 million doesn't mean much for revenue. That $100 million doesn't mean much for revenue. Just to think about three items we have in contention in this budget, none of which in isolation is significant to the deficit reduction strategy, but which by 95-96 or 96-97 will be, those three small measures will be $200 million of government revenue. And everybody who's been in this parliament or any parliament knows what you have to do to either raise another $200 million of revenue or cut $200 million of expenditure, and the social costs and consequences of doing that. So it's not a zero-sum game we're talking about here. That's the other point I wanted to make. I don't want to exaggerate it either. We are talking in 97, 98 about $45 million a year. We would have been talking over the last 10 years on the figures we supplied of about $20 to $30 million a year. So I want to keep it in proportion. I don't want to paint a crisis about $45 million a year, but I also want to say we can't be too cavalier about how we deal with it, because either there's going to be a bigger deficit, $45 million paid by somebody else if it's not here, or $45 million less spent somewhere else. And all those things have their necessary consequences. So I think that in terms of responding to the new issues that are raised, I think those are the essential points I wanted to make. The only other thing I suppose I should respond to make it clear that I think we've covered all the points of the Senate resolution, is the Senate did ask the committee to look at the question of whether this measure is going to have any significant impact on the concentration of financial assets. And I have to say quite clearly it can't. I mean, we're talking about, the advocates of the credit union and their critics would agree on one thing, which is as a percentage of the financial assets of the system, we're talking about a very small amount, and already substantially concentrated in a relatively small number of institutions. So I don't think that's actually an issue. I understand that's a proper one to ask because the concern on the face of it people might have, but it may have social consequences because people are properly concerned about impact on the very small credit unions. But in terms of macroeconomic implications for the distribution of financial assets, there is no measurable, discernible impact. So those are the points I'd want to make in response, over and above those that are made in our written submission, which would be tedious and time-wasting to reiterate. Thank you, Mr. Chairman.
Thank you, Senator McMullen. Any questions for the committee? Senator Watson.
I've got a couple of questions to Senator McMullen. A number of witnesses to the hearing today have suggested that perhaps the issue should be taken out of the heat of the budget deliberations, and seeing that it doesn't affect this year's budget, would the government be amenable to a perhaps more comprehensive inquiry at a later time? And secondly, we've heard some fairly compelling notional evidence from particularly the smaller building societies, where the government might be prepared to have a two-tiered structure, because you do seem to be concerned about the high flyers with the big shop fronts, and I can understand that argument. But at the other time, we do have some smaller people working in perhaps a less commercial environment, where the mutuality principle does appear to me so much stronger, and the need for the retention of a provision such as 23G perhaps more compelling.
Well, can I respond to that first, Senator? I don't think the idea of deferring it for a subsequent inquiry has much merit. It's not, I don't think the problem is lack of knowledge of the facts.
It's been raised.
Yes, I understand that, and it's a point. It's always better to live to fight another day than lose this battle. That's it's a tactic I might have used myself in the same circumstances, but it doesn't give it any greater legitimacy than that.
Where it would two-tier structure, we might have to fight another.
Well, I'll come to that in a moment because I do want to respond to that. But in terms of, I don't think the problem with this issue is a lack of information, which is what would be the case for putting it off. I think we pretty well know what the facts are. It's a question of judgment about what we should do about the facts that is in debate. And so I think the case for putting it off arises only if we find there are some facts we didn't know before, we better stop and reconsider. I don't think there are any facts we didn't know before. The two-tier structure, you can see the emotional appeal, but you know better than almost anybody in the Parliament, Senator, that there's a price to pay for complexity as well. I mean, you just put it, and it would be we would have a problem of if a two-tier structure was developed to say, let's use the two-tier structure that's already in the bill, because as you know, there's two-tier transitional arrangements so that the smaller credit unions... But I'll just say, let me use that dividing line as a criterion. Firstly, so that the committee recalls that there is already a two-tier structure as it relates to the transitional arrangements to give the smaller credit unions greater time to adjust. But if you were to draw that line, the point I want to make will equally apply with any other. And you say $30 million worth of assets and below category A, $30 million and above category B. I think you've got some complexity, but you've also got the capacity for restructuring of big organisations to look like a number of small ones. You and I have both seen the infinite capacity of people to restructure themselves when you provide a tax incentive for them to do so, even sometimes when it's not a rational thing to do. So we would be very apprehensive about how that might be used, and given my significant doubt that the smaller end of the credit union continuum is going to be paying very much tax at all. That's not a revenue concern, because that's not where the profits are. But I do think that it opens some potential for restructuring and loopholes about which we wouldn't be happy, and it introduces complexity where we would prefer it not to be. So obviously, given that we made differential transition arrangements, we weren't ignorant of the fact that there are different categories of credit unions, broadly described as big and small, but I mean more sophisticated, much sophisticated ones, sophisticated financial institutions and very small community groups. But I'm not sure at the end of the day that is going to be a workable distinction.
Could we presume that if we had a differential system amongst credit unions, we'd have pleas from the building societies to have a distinction between mutual and other ones, and big and small?
Chairman, could I make a comment on the big small proposal before another question on the subject comes from another senator? The presumption in the concept of a differential tax treatment for big and small is that the bigger ones either have a greater capacity to pay and or the smaller ones are more deserving of a tax break. Could I make the point that the presumption is mistaken?
It's the mutuality principle that I was talking about.
And the mutuality principle is exactly the same in both. I'm not sure what we mean by big, small, but whatever the numbers might be. Our view is, and we believe it's sustainable on the facts, a big credit union, whatever we call it in terms of asset size, is merely a small credit union writ large. There is not a difference in...
a fat person, a thin person with a bit more weight. I mean, it doesn't take you far.
Well, let's see where it does take us, Minister. Let's see where it does take us in this argument, because there is no difference in kind, there is merely a difference in degree. And the critical similarities in kind are this in relation to this issue. Both big, small and middle ones in between rely absolutely upon generating their capital internally. They are structurally identical in that regard. That's the law, and the law makes no distinction between big, small or anything else. All credit unions rely upon generating their capital from their retained earnings, and they cannot have less than the prescribed amount, which is 8% of their risk-weighted capital. The exact composition of that 8%, as Mr O'Dwyer said, in fact effectively gives them a higher capital requirement than banks or building societies, and it is higher again by virtue of the risk weighting in our balance sheet compared with the building societies. Now, credit union which is big faces precisely the same difficulty. I'd suggest to you that the difficulty is in fact compounded in maintaining capital adequacy because the big one is in fact incurring more of the cost disadvantage in payment system through being unable to issue cheques, having to pay a competitor for every cheque that's issued to its members, being unable to operate an exchange settlement account at the Reserve Bank. They are expenses incurred by the big ones, not incurred by the smaller ones. It is the big ones that pay the bulk of the $7.5 million for their supervision because supervision costs are charged on a pro rata basis against assets. They pay the bulk for the industry. Most importantly, and without any disrespect to the remarks of Greg O'Dowd from Barden Parish, you will find in the submission that I've put before you pages of evidence of what the credit union movement has done in terms of providing, let's call them for the sake of a broad term, good works. The fact of the matter is, all credit unions did that to the best of their ability. But the greater proportion of the dollars is generated by what is being called the big credit unions. And I'm not talking about chicken feed. I'm talking about millions of dollars, which is documented in this submission, both domestically and internationally. The Father Gainey School of Credit Union Training, which was referred to by Greg, in Fiji, is funded in very large part by the Australian credit union movement, as indeed we support a wide range of development initiatives in the South Pacific region, in Vanuatu, in Kiribati, in the Cook Islands, where we're developing a trade union in conjunction with the ILO at our expense. A wide range of initiatives, all documented in this. I've got to tell you that the bulk of the funds for doing that and engaging our domestic welfare program come from the bigger credit unions.
Chairman, can I just respond to that? Because I actually think, that, notwithstanding my aside, I think there's some legitimacy in that point. I'm not here as an advocate of the distinction, and I think the credit union movement has some validity in its argument that the distinction for tax purposes might not be fair. I'm not particularly antagonistic to that point of view. I don't accept that it leads, therefore, to the argument that none of them should be taxed, but I think the argument against making some sort of artificial distinction has legitimacy.
Thank you. Senator Woodley? Yes, Mr Jack.
Respond to, or better still ask Glenn Walker from Newcastle if he'd respond to Graham's remarks.
Thank you, Chair. I represent the Newcastle Permanent Building Society. We're a regional organisation domiciled in Newcastle and operating exclusively in the Hunter region. Over many years, we've accumulated substantial reserves on an after-tax basis. We have no permanent capital. We're about $1 billion in size and have a capital adequacy of 25%. What we've found over many years is that there is a blurring, I think, of in the minds of the public between a building society, credit union and a bank. But at the end of the day, what people are looking at is the best deal for themselves. We found, as an example, that within the Hunter region, we represent 44% of the market share. And of that market share, 52% of those that are unemployed have an account with the Newcastle Permanent. Part-time workers are also attracted to our business. 48% of part-time employees in the Hunter have an account with the Newcastle Permanent. In fact, of our market share, the lowest percentage is in regard to full-time employees. I think it's important to recognise that in regard to how credit unions will perform into the future, be it tax or non-tax, ultimately will be in regard to their own effectiveness, their own operating capacity. I don't think the issue in regard to tax is a substantial one from their point of view. We've grown our business in an after-tax basis. We operate in a similar market. And as far as I can see, I think that there should be a parity of tax between banks, building societies and credit unions. Thank you.
what sort of money do you give for philanthropic purposes throughout the community?
We're a substantial provider. In fact, we were contacted about 2 weeks ago by the Salvation Army. They're in a crisis situation in the Hunter, and we're going to distribute 500 food hampers to the needy in our community. About a month ago, we were contacted by the Lions Club of the Hunter region. They're in fact trying to promote and sponsor injured Bosnian children. We've spoken to private hospitals, we've spoken to medical practitioners, and we're working together through public sponsorship to actually do that. So we're very benevolent in our operation.
Chairman, sorry, could I just raise with Ms very quickly another aspect of his reply?
Certainly, yes.
Minister, you indicated you felt that the effect on small credit unions to be negligible. Under the proposal, as I understand, the credit unions will be placed under Division 9 of the Income Tax Assessment Act, that part of the Act that relates to general cooperatives. Chairman, I'm also chairman of the National Cooperatives Council of Australia, which is a peak representative body for agricultural, trading, worker cooperatives, community advancement cooperatives. I'm also a director of the Australian Cooperative Development League. I've been involved with cooperatives nationally and internationally for 20 years, general cooperatives. Under that particular provision, surpluses are distributed back to members by way of rebate or dividend are not taxable. Retained earnings are taxable. That's been the noose around the neck of the cooperative sector in this country for many, many years. The continuing refusal by successive governments to extend the mutuality principle to cooperatives. The reason that cooperatives in this country have never ever reached the potential of their neighbours in other developed countries in the world is this very provision. Once you put a pressure, and we've seen over the last 40 years this enormous pressure on cooperative societies to distribute all their income back to their members, because that part of their income is not taxed, it's not after tax. It goes back to the members and it's taxed in the hands of the recipient. That pressure has been a pressure away from accumulating a capital base. If you look at some of the cooperatives in Victoria, at Bonlac recently, at Murray Goulburn, they've been driven out of the cooperative sector by that provision of the Taxation Act. Because of that enormous pressure that comes from membership, particularly in hard years, particularly in agricultural cooperatives, to distribute that income back to members, there's a pressure not to retain your capital and not to grow. That's the provision that stultified the cooperative movement. The Australian Labor Party, in its policy, in successive conferences that I've been to, have continually renewed their commitment to the growth of the cooperative sector in this country, to the principles of cooperation. This principle of cooperation, this taxation principle, has proved, Minister, to be the destruction of our cooperative sector in this country. The reason that there's very little value adding done in rural communities is because of this drive to push retain capital away, push it back to the membership. I believe that the same thing is going to happen in the credit union sector, that once you've got a situation, a Division 9 situation, where distributed income is not taxable, only retained income is taxable, there is going to be exactly the same pressure that's happened in every other instance under Division 9 to push all your earnings away from the tax catchment area, to push it back to your members, either by way of increased interest on deposits or increased dividends on, or reduced loan rates.
So
I want to make 2 points.
You're suggesting allowance.
But big
You're suggesting your retention allowance, are you?
I'm saying retention of 23G, that there's a necessity to retain capital even in smaller societies.
You're talking about two different things.
Yeah.
You're talking about the trading cooperatives,
yes,
where they're only taxable on the amount that is retained
yes,
after the distribution to shareholders. But in that case, what you're really arguing is for a retention allowance similar to the old Section 46 rebate calculator or retention allowances.
That retained earnings shouldn't be subject to taxation until somebody has a right to those earnings.
Sufficient amount.
I'm
not sure about that, but you're really advocating that there be a retention allowance before they have to distribute in terms of removing the pressure from the shareholders.
Yes, Senator. In New Zealand, for many, many years until this recent government, this was recognised in their cooperatives law. What it in fact says is this, that when a cooperative retains earnings, as I said earlier, no one's got an entitlement to that, because someone leaves the co-op, they get their share back at par value. The argument's not on taxation, Senator. The argument's on the point of taxation. That surplus that's retained, when someone gets an entitlement to it or when it's distributed, it should be taxed. Nobody's arguing that that retained earning shouldn't be taxed. We're arguing the point of taxation. If you make a distribution of that retained earnings, then it's taxed as income by the person who receives it. If you wind the society up and that money is distributed back to the shareholder, it's taxed then. If you issue bonus shares to distribute that surplus, then that's taxed too. We're not arguing whether it should be taxed or not. We're arguing that it's inappropriate to tax it, Senator, at that point in time before someone has received an entitlement or a contingent entitlement.
Minister.
I don't want to extend this debate, so I just want to make 2 points in response. One is that what Mr McCall has said establishes a point that I intended to make earlier, which is that other cooperatives in Australia are taxed. And so this is not some unique thing that we are creating, including, I might say, cooperative building societies, but not only cooperative building societies. And the other point is that he reinforces, and I'm not in any way challenging the accuracy of the point that he made, the tendency for people to restructure their operations to respond to tax incentives, even when that restructuring isn't always the most sensible for the business concerned. And that reinforces my concern about as Mr Lachlan was saying, my concern about the distinction between large and small. You wind up getting restructuring arrangements that may not be sensible, that might be tax advantaged, and I don't think we don't want to use the tax system as a mechanism for getting credit unions to restructure themselves.
Senator Woodley.
Part of my question is starting to be answered, I think, and that is the Democrats added the G reference to the bottom of the references put by Senator Hill, and that is that we're interested in the effect on housing cooperatives, mutual savings banks. There are some of these that exist in Brisbane, in old Methodist parishes, and also some of the small friendly societies which have a very long history. And I'm wanting to know, I realise that this particular tax measure does not extend to those particular institutions, but I want to know what's in the government's mind in the future. Will they extend these kind of provisions to those groups? I have a great interest and involvement in some of those cooperatives.
If it's appropriate for me to respond, Mr Chairman, it's a bit... it's not an issue that's ever been discussed, so I can't say what the response is with regard to that. I know of no such proposal, but I'm not going to stand here and swear it'll never happen because, to the best of my knowledge, it's never been discussed. But I don't think any of the same sorts of pressures about distortions and competitive problems arise unless we start getting $100 million bodies in that area, none of which exist to my knowledge, but you may know something about them that I don't.
Just while we're on this term of reference, it would be helpful if anybody has a contribution that would help us to answer that term of reference.
Could I just make this comment, Senator? My view is this, from a taxation background: once you destroy a proper principle, in this instance the proper principle of mutuality was what established 23G in 1974, once you destroy that principle, then who knows where it will go. And it seems to me that the Minister's answer in essence says, well, it won't go there until they get big enough to treat with this principle with them as simply an expedient. And I think that's a very important issue. The principle of 23G is correct. Right now the argument is about why it should be swept away.
Well, I let that go through the keeper the first time, but I don't take comfortably to people saying, well, there's a principled stand and there's my stand which is principled and there's everybody else's. I have to say I don't like that. The reason that the mutuality principle doesn't apply to credit unions is because the High Court said it shouldn't. Now, let's not muck about. And there are a number of other cooperative bodies that are taxed. So I think there is an argument about whether or not credit unions should be taxed on the merit, and it's been put by the credit union movement today, and they're entitled to make it. It's not without legitimacy. It's been the prevailing argument for 20 years, so you can't say it's an argument with no merit. Both sides of politics have broadly supported it for 20 years, so it's an on-the-balance thing. But it's not a question of there's a principled stand or there's some other thing. It's not quite as simple as that.
Mr. Chairman, can we get clarification at that point? Because it's my understanding that to just pick up the 1974 decision and say, well, the High Court said quite definitively the mutuality principle in this issue is not there, is not right, and not a fair interpretation of the circumstances of that ruling. Now, I think when you have an in-depth look at the circumstances surrounding that and the subsequent actions which might have taken place but didn't for good reason, there is, on my advice, and I'm not a lawyer, thank heavens, I'm advised that to pick that thing up and say that's a definitive answer to all your arguments just isn't quite a fair approach, and perhaps there are some lawyers.
It's not actually what I was trying to say, Mr. Ahern. I understand the point, and there's nothing unique about high courts making decisions after which governments have to legislate to implement what they thought should have been the situation, and perhaps sometimes what they thought the situation was before the High Court made it. We're all familiar with those, and that they sometimes get very difficult. But all I was trying to say is that's why the mutuality principle doesn't apply in the Tax Act now. It's not a matter of the High Court having the right, or I'm not as familiar with the judgment as some here, but I don't pretend the High Court went to an evaluation of the merits of credit unions and found against them. That wasn't the point I was trying to make.
Could I ask a question?
Yes, Mr. Martin and Mr. Lachlan, and then we must move on with some other questions.
My question is somewhat different. I have been approached. I'm quite active up in my own area, in the beautiful climate of Woy Woy, and I've been approached by some members or some officials of licensed clubs. Mm-hmm. As I understand it, from my own experience in the tax office, if the credit unions and the legislation goes through in its form now, taxing credit unions, the way is open for a government to tax licensed clubs, because the same principles apply in a licensed club with non-member income, for example, or and as applies, as I know it, in most credit unions that I've been a member of and aware of. And it's a real danger. I know up in that area there was clubs making over $1 million net profit a year, and they're not alone. And there's a bit of turmoil around in those licensed clubs on account of what the government has done, and as far as the credit union movement. Is there anything on the...
The tax office is targeting some of the clubs on account of the mutuality principles.
There's been for a long time, other people from the tax office can supply, if we want to pursue it in detail. I fortunately am now not so closely involved. I can do it in detail, and I'll get someone from the tax office to do it if we want to pursue it further. But as a general response, there has been for a long time an operating agreement that licensed clubs pay tax on their non-mutual income. The argument has only been about the formula for determining their non-mutual income, and that, subject to the debate about the formula, which goes on, that operation of taxation of licensed clubs is satisfactory to the government. We have no proposal to change it. We might argue with them, as we do regularly, about the formula for determining what is non-mutual income, but we have no proposal to change the basis.
Can I just say that one member of the lower house, well, the House of Reps, who was the vice president of a large licensed club, the Reesby Workers Club, is my successor, Mr. Mellom, and he's a bit worried, I can tell you that.
Thanks, Mr. Martin. Mr. Lachlan.
Chairman, I just wanted to draw to the committee's attention that there is an appendix in the submission The last 2 pages, it's not produced by me, of course, but by a lawyer, which is a digest of the position taken by the High Court in relation to 3 cases that came before us. And the gravamen of the issue is this, that the pity of it was that the common law evolution, or the evolution of the common law principle of mutuality, ossified before credit unions ever got before the courts. The court found that on one of the 4 grounds, credit unions did not qualify on a technicality, and that ground was simply this, that for the mutuality principle to apply, all the members who contribute to the common fund must be the same people who stand to benefit from its distribution. And technically that doesn't happen in a credit union because only part of the membership, those who have taken out a loan, contribute to the income, but in theory if there were distribution, all of the members would benefit. What happened, and I just want to make the point of this, is the court chose not to extend the common law. It hasn't done it in Australia. The UK courts never had a credit union case come before them, but both governments in the UK and Australia took hold of that, and in the UK they put in a section in the Corporation Taxes Act exactly the same as section 23G. It's section 487 in the UK Act, it's 23G here, and it gave by statute what had been denied by the courts, and what that is exactly the application of the mutuality principle, no more, no less, so that under 23G it is only that portion of income derived from members which is exempt and any other income is taxed. So I just draw the committee's attention to that, what the court's position was, why they came at it from a legal point of view in 23G as they did.
Would you like the UK position replicated here?
Pardon, Senator?
Would you like the UK position replicated here?
Well, it is effectively replicated now. Section 487 of the United Kingdom's Corporation Taxes Act is the equivalent of section 23G of the Australian Income Tax Assessment Act. What we have done in Australia, what we did 20 years ago, is the same as the Brits did, and the Americans, by their own statutes, have effectively the same taxation provision as well. That is to say, they have all decided that if the courts won't move the one extra leg to grow the common law principle or the application of the common law principle, then parliaments or congresses shall do it for them.
But you can get around that by issuing somebody with $1 share to become a nominal member, can't you? I mean, that's how you get around it.
Well, perhaps you can, but we've not ever had to get around it because the parliaments have fixed it up for us and given us the statute.
Yeah.
And that's what we wish to preserve.
Senator Campbell.
Sorry, Campbell or Campbell?
Well, you must decide between yourselves. That doesn't worry me. Senator Campbell.
I was just going to ask Senator McMullen, in his opening remarks, he referred to the rich using the poor, the rich hiding behind the poor. I was just wanting to know, because he was quite specific as he opened his remarks, and it came straight after the evidence provided by some of the credit union people, who he thinks are the rich and the poor in this argument.
What the point clearly means is that the very large credit unions are shielding their competitive position, are seeking to shield their competitive position from tax by conscripting to their aid the very small credit unions, such as those parish credit unions which were discussed.
So you say that the big credit unions are rich and the small credit unions are poor?
If you want to use it as a pejorative, no, I'm not being pejorative about them, but I'd rather, in terms of measuring rich and poor, I'd rather have $100 million of assets than one.
You'd rather have big credit unions than small credit?
No, I'm saying if you distinguish, I'm not advocating either. I'm simply saying if you want to use the word rich and poor, we could have made a much longer speech, but I think most people know what you mean when you say the rich are conscripting the poor, or the powerful are conscripting the weak, if you like. It might have been a better way of expressing the same point.
Senator Kemp.
Thank you, Mr. Chairman. One of the minds that is turning the Senate at the moment, and particularly in relation to the whole debate on the budget, is the principle that the government made certain commitments and promises before the election about taxation. I think there is an argument that Senator Evans has run very strongly that he says the commitment the government made was to no new taxes. And of course I think there is an argument that could be mounted this is in a sense a new tax that is being imposed.
It wouldn't be true, but you could match.
And the Senate will, no, the Senate will have to, well, it's a new tax that's being applied to a group that wasn't taxed before. And I think that they would feel it was a new tax, even if you don't, Senator McMullen.
Still not right, but go on.
Well, but the principle is clearly right, that you have argued and your colleagues have argued in the Senate that the commitments you gave to the people was there would be no new taxes, and we will have to resolve that argument ourselves as this debate continues. Can I ask any members of the credit unions here, in negotiations before the election, did you have any discussions with Labor Party members or ministers regarding your taxation treatment, and what assurances, if any, were you given?
Well, can I just say, in response, I'm active Labor Party now. There was no discussion, as far as I was aware. Mr. Frank Walker is a minister in the state. He attends our branch meetings, and he never raised any issues on them. Every person I know within my own area in the Labor Party was shocked when it was introduced. Simple as that.
Anybody else? Mr. Lachlan?
Sorry. Senator, we had no discussions with the Labor Party as such. There were, I'd like to add this because we believed that we had an assurance. The reason we did was because this matter was examined in some detail by the Martin Committee. They took evidence on the matter. They examined witnesses on the matter. And I was one of the witnesses who gave evidence on it, but not the only one. And I might assure you that the questions asked were of us in defence of the tax, to defend the tax, were more rigorous from your side than the government side. They were led by the former member for Sturt, Ian Wilson. The position taken unanimously by the Martin Committee was, having reviewed the matter, it was in the public interest that the tax exemption should remain in place, and all the members, there was no dissenting report or minority report to that. Now, that was tabled not so long before, I don't know exactly when, the last election, and it was our understanding from that there was that the government would probably adhere to the policy. I mean, I'd appreciate the point technically that the Martin Committee didn't speak on behalf of the government, but that was as close as we got to it.
Was there a government response? I just can't remember.
A government response to the Martin Committee? There was, a very substantial government response, and to the committee's report in its entirety. To the best of my knowledge, and I'll ask David Taylor, who might know the detail, there was nothing said in the government response specifically in relation to that recommendation, and we have interpreted until now that their silence was consent, as I'm sure was the case with a lot of I mean, there are over 1,000 recommendations. They didn't recommend every one of them, report on every one of them. Did you want to add to that?
I think that's correct. There wasn't a specific reference on the matter of the tax exemption. There were, of course, a number of references in that report to the work done by credit unions in the community and to the kind of lifeline banking services, as they were called in that report, that credit unions provide. But as far as I'm aware, nothing specific on the exemption.
Could I also make a comment, Mr. Kemp, in relation to your question? There was nothing in the I concur there was nothing in the recommendations of the Martin report. The Campbell report was very adamant, and that's evidence from that, and the record of their advice is included in our evidence, and I commend you to read that. That was that, in fact, it should be phased out for very good reasons and the sorts of reasons. So for the credit unions to suggest that they weren't, it was a non-event and they were they had comfort that the politicians of Australia were not looking at it, is probably an oversight by them. And as I said in our remarks, we've drawn it to the attention, not of politicians generally, but of the government of the day, consistently, and to all submissions, to all reviews of the financial system and the tax system as well. So I really do think that it is a fact that it's been on the agenda and it's been an issue, and it shouldn't have been a surprise. What has been a surprise, I think, to me, has been the volume of the subsidy. That over the last 20 years you're looking at a subsidy or a cost to taxpayers well in excess of $200 million. And if there's not some redress of that, my question really is to the senators, are you knowingly willing to preside over further subsidy, which the bigger the credit unions get, the bigger the subsidy gets?
Now,
that has to be a concern.
Just a second. I don't want any responses yet to the points Mr. Larkey's made, but just on to finish out the earlier question, Mr. McCall or Mr. Ahern, you have something?
Senator Kemp, on the question that you asked, our association made no approach to Labor politicians or to either side. When the assurance was given that there would be no new taxes, whether through some semantic argument, ministers' advisors are able to put forward an argument that this isn't a new tax. Nevertheless, the perception was, by our membership and the members of our members, the perception was that there was an assurance there by the government there'd be no new tax. Whether that's what the government meant or not, that was the perception that was widely held. We acted on that perception. We believed in good faith that a government that had consistently urged consultation processes that are through the tax summit and the like, that if there was to be any change, that there would be a lengthy consultative process, as they've been rightly put forward by this government in every other circumstance. But if there was to be any substantial change like that, that we would at least have the chance to put our case fully in the type of tax summit, in the type of consultative process that this has been a consistent hallmark of this government's activity over the last 10 years.
Just very quickly, Mr. Chairman, I'd support the general remarks by my colleagues, but I'd also make a further comment that may not be helpful, but I'll say it anyway. The reality is that we did approach the coalition before the election and received written assurances and inclusion in the manifesto that the tax had been considered and decided that it was not on as far as the coalition was concerned.
So one of all the members rushed to vote for the coalition at the last election?
I think it's something you need to take into account as you're considering this totality of issue, because there was a concern as to what the coalition's attitude might be, and that was thought to be a greater concern to what might be coming out of the Labor Party's action.
Senator Kemp.
This issue of the consultation is an important one for the long term, because it has been a feature of public policy for years now. I think it's now, because of March the 13th, it will forever change. But I advise everyone in the room to read carefully the words of Gareth Evans, I think in answer to a question in Wednesday's question time or Tuesday's, where he talks about this issue that Senator Kemp's raised in terms of consultation and what people's expectations were of the government's tax policy. Which of course there's ongoing debate about, but Senator Evans actually said that thinking Australians would have understood that there needed to be revenue enhancement measures after the election, and so clearly the credit union movement has failed and probably fails to meet up to Senator Evans' expectations in terms of being thinking people, because clearly you just did not read the fine print closely enough before the election.
Would you like us all to make policy speeches, or are we going to get on with it?
Yes, I was just going to say, I don't think we've got...
to make one, but
yes,
it won't
I don't think we've got time today to delve into all those arguments as much as some would like to, because we have certain terms of reference before us that we need to look at the provisions of the bill, and while of course one would expect some byplay along those lines, I don't think we can afford the time to spend a lot of time on it. Senator Woodley has a question.
Yeah, my question really picks up probably the first three of the references, A, B and C.
Yes.
And it's a concern I have, and I think I direct my question. Is it appropriate to direct a question to Mr Ahern? Or?
Sure. Yeah.
It's particularly to do with the philosophy of what we're talking about, and I'd like to hear a bit more on that debate. I was concerned by Mr Larkey's comment, and he probably will also want to respond, that if we want to get into social justice the social justice aspect of credit unions, then there's a social security system to pick that up. Now, that kind of comment concerns me because I make a clear distinction in my mind between welfare and social justice. And it seems to me that what credit unions are on about is in fact a principle of social justice, the empowerment of their members in terms of their financial arrangements. Whereas the kinds of issue that Mr Walker referred to, in which building societies may in fact help the Salvation Army or whatever, is in fact another issue. And there is a clear distinction in my mind between the social justice aspect of what credit unions are on about and that social security system or welfare system or whatever you like to call it, which is quite different.
Yeah, Mr Chairman, I want to agree with the Senator's obvious philosophy and to say I too take strong exception to what Mr Larkey has talked about in using the pejorative terminology of subsidy. Those numbers that he's throwing around are off the top of the head figures, and they are a slander on the credit union industry, and I know that I speak on behalf of all of them to say today that this is a most indecorous, unuseful dispute between credit unions and the building society movement, and it ought to be much more objectivised than that. It is something we reject completely. The issue of mutuality is something which is time-honoured. It's come from a long way back and it's all over the world. And if it's right today, in wherever we are, to tax credit unions, why aren't the other people around the world in the majority doing it? They're not doing it because of these issues of the good that's done and because of the issues of mutuality, which are fundamental issues of fairness in the community.
Mr Chairman,
Mr Taylor, hang on. Can I just suggest, on each of these issues that arise, I don't think we can spare the time for every one of the witnesses to say something. So I was going to suggest that Mr Taylor briefly respond, then I'll give the Building Society representative a chance to come back about it. And I think we can just go a few minutes past 12 and then we'll resume at 1:30. So if we can finish on these couple of comments and then we'll have to adjourn till 1:30. Mr Taylor.
Thank you, Chairman. Senator Woodley's focused on an important point there which we do deal with at some length in our submission. And it's contrary to some of the suggestions in submissions that I've briefly looked at from the building societies, and that is the suggestions that building societies and others are providing the same services, making the same services available to the community. Now, we've detailed many areas that fall in that social justice, if you like, category, where credit unions are doing distinctive things and they are providing services which aren't available elsewhere. But I wanted to just draw the committee's attention to a couple that we deal with in our submission. One is low-value loans, particularly loans for short periods for small amounts of money. Now, what we find is that the banking sector increasingly are moving out of that area. Building societies are primarily, as we know, involved in housing lending, and the banks have taken the view that those small value loans are simply not profitable. Now, they may provide you a credit card, which many customers don't want, and with the opportunities for overcommitment and so on, but they won't provide you a small loan. Now, credit unions do, and credit unions, big, small or in between, hold that as a matter of philosophy, that someone, if they require a loan for $1,000 over 1 year, repaid in small instalments, they should be able to do that. And the fact that credit unions do that, and that it is unique, was confirmed in that New South Wales Commercial Tribunal report last year, and I'll just quote 3 lines from page 50. One where they said credit unions appear to be the only institutional lenders who are likely to lend amounts between $500 and $2,000 on fixed short-term contracts repayable by instalments. Now, there are other things too in relation to small deposits. We provide small deposit accounts without fees to those which haven't got a lot of money, and in some cases we've got credit unions with over 70% of their deposits held in accounts with less than $300. Now, these are services which, to refer, if I could just refer briefly to the letter distributed by the Treasurer, where he suggests that if the tax exemption is removed, it may well make credit unions more efficient. Well, that may be so, but what kind of efficiency, what avenues for efficiency will there be? And the obvious ones are to cut back on many of these services which are unprofitable. They're unprofitable for banks, they're unprofitable for us as well, but we're prepared to wear that cost. Those are the services that will go if this tax exemption is removed.
Thank you. Mr Jack.
Please, the question earlier as to whether or not the credit unions expect it. Let me quote you Mr Philip Elliott, who's sitting over here in the Australian Financial Review on the 19th of August, who said that the move had been to some extent expected. The question of whether or not Mr Larkey's throwing around nonsense figures, he's quoting the Federal Treasurer in this morning's Australian Financial Review, who says the cost was $270 million. As to whether or not those court cases are not frozen or ossified, I think, the common law. If, in fact, the credit unions maintain that they are still mutuals, and they are no different from the Newcastle Permanent Building Society, which is just as mutual, and it pays tax, and has for the last 20 years and more.
Thank you. Well,
if I could just respond to Senator Woodley. He did explain.
Oh, sorry, I thought that was what Mr Jack was purporting to do.
I hope on the question of social justice, I guess what we are saying is that as building societies, we're also getting people into houses, and there's umpteen examples of where the societies are carrying people who have bought a house, come on hard times, and so on. So we're in that area of supporting self-sufficiency and thrift. I guess what I was on about is that the facts are, and I indicated when I talked about the need for the committee to winkle out the large and the small credit unions, the thing is that the subsidy goes to the institution. It doesn't go to the individual. So because of that, and the way it works is that, as we've said before, high income earners, senior public servants, senior Qantas pilots, all of those people, they are also getting the subsidy in some little way. If the subsidy could be channelled directly through the credit unions to the sorts of hardship cases we hear about, I couldn't endorse it any more than having say I do endorse it. But the difficulty is that when it's a subsidy to the institution, then that subsidy flows to all who use it, whether they're on $250,000 a year or whether they're on nothing. And that's my concern, Senator.
Thank you. The sitting... Oh, sorry.
Wind up for now. I understand, of course, the committee will need to consider its recommendations, etc. Do you need all of us back? I mean, do we need to come back at 1:30? I mean,
well,
is there more evidence to be provided?
There are questions from members of the committee that they might wish to ask of you, or tax or treasury officers.
I'm here, but I'm saying I don't just turn up, have everybody here, wait around over lunch, and then find that.
Tax questions.
We'll be here, no problem.
All right. Well, the sitting of the committee is suspended until 1:30. Order. The committee will resume. The The Minister may be a little late, but if there are any matters that officials believe that he should answer rather than them, they can be held off for a little while until he gets there. But I think we should make progress in the meantime. Now, questions from
Well, Mr. Chairman, I was just wondering whether we might be able to have extend the privilege of speaking to somebody from Bathurst.
It's a suggestion that a small building society wants to put their point of view to us. If there's no objection.
A very small building society.
If there's no objection, please introduce yourself and give us a few minutes.
Well, what we're interested in, differences, rather than necessarily what Mr. Larkey might have just said.
Of course. Okay. My name's Colin Hope. I'm the General Manager of Mitchell Building Society. Mitchell is based in the central western region of New South Wales and has an asset base of approaching $18 million. We qualify as being the seventh largest building society in New South Wales, or the second smallest, whichever way you look at it. Basically, we see ourselves as a very cooperative type institution. We have no account keeping fees for our customers. We provide good quality, low cost loan services. Our home loan rate has been below that of the major banks for the last 3.5 years now. It's a part of our philosophy. We see that we belong very much in our market niche, as many small credit unions do. In the past, we've seen ourselves pretty much complementary to the credit unions within our city. That has been changing over the last couple of years, though, as our credit union has diversified and spread its wings to neighbouring towns, added fees for their account holders, etc. We find that, we feel anyway, that we're perhaps more in tune with the cooperative nature of providing financial services than many of the other 7 banks and 7 credit unions that operate within our area, and we pay tax. We've added almost $400,000 worth of tax to the federal coffers since 1977, which equates to the entire building credit union industry across Australia for this past year. So we feel we're quite corporate citizens. Whilst we acknowledge the services provided by credit unions, etc., we feel that we're no different, yet we're treated totally differently. We're totally cooperative, and we have no intention of offering fixed share capital, which some of the other institutions have in recent times. Basically, that's it.
Well, perhaps I should ask, how can you, if you like, legitimately be under the same umbrella as the large building societies? Is there perhaps a distinction between the building societies with shareholders and those like yourself who are more like credit unions?
I guess if you look at Newcastle Permanent Building Society with assets of $1 billion, we're exactly the same.
In terms of your
yes, I'm not talking about size, I'm talking about the nature of whether or not you are mutual or otherwise.
Well, I see us as cooperative more than mutual. I think that it's really a business philosophy. We follow the way we do business simply because that's the way we want to do business. I think that in essence, there is no great difference between a large building society, whether it be one that issues fixed capital and a small building society, or a large credit union and a small credit union. And the industries really are very similar.
Or banks, presumably.
I guess so.
The capital of your members, does that increase? I mean, credit union has made a very succinct point that you put in $1 and that dollar stays $1. It doesn't, the reserves go to the body corporate, as it were, rather than to the member. What happens to the shares of your members?
Well,
do they increase over time as you grow?
No. All of our, well, as we grow, we make a profit.
Yeah.
As those profits are then taxed and they're put into reserves.
But do those profits accumulate to the individual shareholders?
No. No, they're kept in general reserves, and those reserves form the capital of our society, very much the same as...
So if I come in and it costs me $500 for 500 shares, and I decide get transferred to another town in 10 years' time, despite the fact that your reserves have grown, all I take out is $500?
That's right, plus interest. Basically, you make deposits. There are no shares
Yes, but
within
no,
our
but
society.
Senator Watson was raising...
shareholding.
Yes, well, they don't have... As I understand it, you don't have shareholders.
That's right, we don't have shareholders. Every depositor has an equal vote. There are no permanent shares issued by our building society.
Mr. Ahern.
Why you haven't become a credit union?
We see no real need to. We're quite happy to operate a very effective and efficient
Could have
business.
saved your members $400,000.
I'm sorry?
Could have saved your members $400,000.
Wasn't possible.
But I guess this was the point I was getting at, isn't there more similarity between you and the credit unions than between you and the not only larger but the shareholder, the building societies with shareholders?
That's precisely the point. What is true...
We want to treat everybody, who operates a similar business.
Well, they're not identical, Senator. There's a lot more similarity between the Mitchell Building Society in Bathurst and the Newcastle Permanent, which is infinitely bigger than Mitchell, and credit unions, than there is between those two building societies and building societies like Home that are wholly owned by another organisation and are joint stock corporations or subsidiaries of those for all practical purposes. Not all practical purposes, legally. Now, the fact is that the law that governs in the enabling legislation for credit unions and building societies has sort of recognised that building societies and credit unions may wish to change their corporate nature. It has put in a provision which allows building societies to convert to credit unions. It's impossible for those that have issued joint stock to do that, of course. They can't unscramble the egg.
No.
But for those that wish to, and have not gone the extra step of permanent share capital, there's probably all sorts of inducements as to why they might, not least being the taxation situation. It strikes us as extraordinary that the position taken by the building societies wholly is to come in and play beggar thy neighbour against the credit unions, when the fact is that some of them have got more in common with us in many ways, but not all.
Well, we're trying to distinguish that.
And one of the distinctions is this. There is not complete identity of the two in this respect. The point is that anybody can walk into the Mitchell Building Society, I guess, and by virtue of making a deposit become a member. That can't happen in any credit union. It may well be that some of them advertise, as we were told earlier, and advertise publicly, that is credit unions. But the fact is, when somebody approaches the credit union, the test that must be made under law is, does this person fit within the rules governing eligibility for membership called the common bond? And if they don't, the credit union can't accept them as a member. Now, we've retained that in the law. We want to retain that. It's one of the very important elements of cultural distinction. Sorry?
Not all credit unions work on that basis. They say yes and you pay $2 and you're a member.
No, not of a credit union, Senator. The credit union's rules, let me just explain this point. It's a very important distinction between credit unions and any other financial institution. The Financial Institutions Code says, and it's always been this way, we want to keep it this way, a credit union can accept into membership only those people who fit within a class of eligible persons as defined in the credit union's rules, and those rules in turn must be approved by the supervisory authority established by the state government. So it might be the employees of Qantas Credit Union, which is here today, or it might be the people who fall within the parish of Barden. Greg O'Dowd spoke to us from Brisbane a little while ago. But they can't take people into their membership fold outside that area.
But it can be a fairly broad membership fold, can't it?
Sorry, it can be, but they've got to establish to the satisfaction of the authorities that there is a common identity or a common interest amongst those people. Now, that is a material distinction between a credit union and any building society. But of course, a building society like Mitchell could fix it very easily. Very easily. Could be the citizens of Bathurst and environs. And then they could exercise the conversion provisions of the bill, or the Act, and be a credit union.
Just a second, I was going to give Mr O'Dwyer the next call. I think you were trying to say something a minute ago.
I was, but I'll rest on that.
Reserve it, right, Adam? Just a second, you'll certainly get your chance to... I'll just give Mr McCall a brief mention and then Mr King.
Thank you, Chairman. Senator, on your question about the shareholding of individuals in societies like Mitchell and Newcastle Permanent, the essential difference here between a credit union and building society is that while credit unions are very good, building societies, very good building societies like Mr Walker's organisation and Newcastle Permanent for that, while they operate as mutual societies, they have the potential to give that reward back to the shareholders that credit unions don't. For instance, Newcastle Permanent, one of the commentators on Sydney Radio some weeks ago said to his listeners, if you want to know the best investment in Australia at the moment, get a savings account with Newcastle Permanent Building Society, because when they list, you will make a fortune. And this is the thing. Mr Jack said this morning that we all know where building societies are going. We do. They're all marching off into the banking sector. We've got Co-op in South Australia that's becoming a bank. The one that Mr Dwyer referred to this morning in Queensland went onto the market, $1.20 for its members, $2.40 it opened up on the market when it went into this banking operation. So basically what we're saying is that it's not so much, and they're very, very good societies, those two building societies, but the point is, the fact is, that they can go and convert to a bank any time they wish, providing the Reserve Bank allows them to and they meet the criteria. But the potential's there for the distribution of those reserves back to their members in terms of premium. In the premium value of their shares. The potential's not there for credit.
Now, was it Mr King? You wanted to just a second, Mr King was going to...
Yeah, first of all, twice now the comment has been made about Home Building Society, and I want to put the records right, that Home Building Society is not a wholly owned subsidiary or is a privately owned building society. We have an association with GIO Australia, who only own 8% of the voting stock of Home Building Society. So I just want that to be put on the record, please. Now, as far as the way, and I believe that the previous comments really are irrelevant to this debate, because this debate is about tax, and it's tax on players that are in the same financial system. Now, just the other day, I contacted a credit union, and over the phone I was given approval for a loan. And when I said, well, don't I have to be a member? And they said, don't worry about that, sir, we'll sort that out when you fill in the form. Now, that's how easy it is. Now, I don't want to bag credit unions, but there are credit unions that are competing in the marketplace, and they are offering exactly the same services, and we have our membership, and when you invest in a building society, you become a member, and you have voting rights the same way as you have voting rights in credit unions. There are differences in the marketplace, there is difference in structures, in balance sheet structures, but those structures are irrelevant to the tax issue. If you raise capital, you still have to service it, and you have to service it after tax, out of your profits. So it's irrelevant, this issue about permanent shares and capital raising.
Just a second. Now, did you need to correct something, Mr Hope?
Well, I was asked, is it right that our reserves can be passed back to the future benefit of the members if we decide to become a bank? Well, the only way that could happen is if we were to be taken over by someone. Our local credit union made approaches in that direction only 2.5 years ago. Wanted to know whether or not we'd be interested in joining them. I see that we and they were complementary and supplementary in the past. I think we're now totally head-to-head. In competition, we offer pretty much the same services. They do home loans, we don't do personal loans. They offer cheque accounts, we don't. But still, I see us as two similar institutions. So, and I know that we both are very good. I'm sorry.
Who's growing at the faster rate?
I can't hear. I'm sorry.
Who is growing at the faster rate?
We are.
Now, can I just check with...
I think our service is excellent to start with. That's about it.
Now, can I just check with the other representatives of the building societies, just to check if there's anything else they wanted to say on this issue of what some of us might see as a major distinction between the shareholding and non-shareholding building societies, while accepting your point that on one level one can say this is purely a tax issue, ignore structures. I'd just like to get on the record your point, your response on the differential within your organisation.
The credit unions are making much of the fact that retained earnings is their only source of capital, and that's not true. There are many other forms of capital other than permanent shares that they can raise, and in any event, Graham Lachlan was one of the ones from the credit union movement who argued very strongly during the formative period of AFIC that credit unions should not be allowed to raise capital if it wasn't necessary. So, you know, if they can't raise capital, it's because they didn't want the ability to raise capital.
I've got to begin.
That's all. Any of you want? Oh, sorry, Mr. Hunt.
I'm from Bendigo Building Society. I don't think I did introduce myself before.
Oh, fair enough.
I apologise for that. Bendigo Building Society.
What category are you in?
Sorry?
Are you in Mr Hope's category, Mr Walker's category?
No, I was just about to explain that.
Right.
Bendigo Building Society is the oldest building society in Australia. It issued permanent shares in 1874, and we are a building society despite all of the philosophical debate that goes on. We offer the same services as any other building society to our clients, and after all, that's what we're really talking about. It's not the balance sheet structure that changes the services that you provide and the pricing that you actually wrap around those products. And the real issue about the tax issue comes back down to what business are you in, not what structure is the balance sheet, what business are you in? And they are all in the business of lending money, accepting deposits and carrying on the business of finance.
But you're a bank now, aren't you?
Sorry?
I thought you were a bank.
Oh, we are not a bank.
Aren't you?
No.
Bendigo.
Bendigo Building Society. We issued, I'm not going into the circumstances, we issued permanent shares, but it did have something to do with some confidence about the rights and obligation of members versus depositors in Victoria. But we don't want to go on about that. As I said, I think the balance sheet structure is separate. I am still a building society. I trade every day as a building society.
Sure, but you can understand...
I can understand the dilemma about
somebody
the
who
structure.
doesn't understand the system, seeing that there is a gulf between your two different types of members.
There are differences in terms of the balance sheet structure and some voting structure. But in essence, the products and the services offered are precisely the same. And that goes for credit unions as well, and they don't have the domain solely on the basis of providing support to the needy. They do not.
Now, Mr Lachlan, you want to respond to a particular matter that mentioned your name.
Can strangers claim misrepresentation? I just wanted to respond to that. It's perfectly true, as Peter Jack says, that we argued before the state authorities that when the laws governing credit unions were rewritten a couple of years ago, we did not want included a provision enabling credit unions to be able to issue permanent share capital.
Oh.
I must say, firstly...
Do you still hold to that view?
Absolutely, yes. That represented the status quo. That has always been the case. It is the case now, and we want it to remain the case. And the reason why is perfectly consistent with the position we've taken in relation to this tax. And that is, we wish to maintain our mutual character. We wanted to then, and so we took such steps as were necessary to prevent a law being written which would allow people to come onto a share register and exercise a level of control incompatible with the mutual principle, the principles of mutual ownership. We come before you now on this separate matter, perfectly consistent with that view before, and that is to say we are mutuals. We've always remained so. That has certain implications for capital raising, capital formation, and they directly bear upon the tax measure that's before the Parliament. We don't want that to go through because we can't get by. Chairman, to finish that off, if I might, and it's very briefly this. The test that is applied conventionally in tax matters as to horizontal equity is not a test made on functionalism. This argument we get, we're all in the same market, we're all providing the same services, which, by the way, we're not. We've just been told by Mitchell we don't provide the same services in Bathurst. They provide one lot, we provide the other. The test is, in tax neutrality, it goes right to the constitution of the bodies concerned. And it says we treat the same way like bodies, and if there is distinction between the bodies, then there is a prima facie case for saying that they should be treated differently. What we have in the Credit Union Building Society situation over 20 years is the position that there has been material difference in the structure, where mutuals they're not. We can't issue permanent capital, they can. We don't distribute to members, they do, or if they don't, they have the capacity to do so. We transact business only with members, they don't. Our members can come from only a defined group, theirs don't have to, and so the list goes on. And they are the differences, the substantial differences which have given rise to the different tax treatment.
Now, I'm tempted to, just a second, Senator Watson, I'm tempted to suggest that the committee tiptoe quietly away and leave you to lot to it and see who survives, who emerges from the room. Can I just suggest? There has to be, I guess, some limit on the toing and froing of correcting misrepresentations and so forth. Now, Mr. Taylor wants to say something on this issue.
Yes, very briefly,
now,
Chairman.
but just only if it's something different from what's already been said.
Well, my colleague has already covered some of the ground I was going to cover, but simply to make the point, further to what Graham Lachlan has already said, that while we were pushing so strongly in relation to the development of the FI Code for credit unions not to have the ability to issue permanent share capital, there was no one, to my knowledge, within the building society industry pushing that line in respect of their members or some of their members. On the contrary, the strong line pushed by the building society industry was not only that their ability to issue permanent share capital should be maintained, but even further, that there should be allowance for greater individual shareholdings than was initially envisaged in the development of the code, and there are some exemptions that deal with that. And the second thing I'd like to say in relation to that is to consider this in perspective. We now have, I think I'm right in saying, 31 building societies, and around 20 or 21 have issued share capital. So we are talking about building societies in a small group of 10 or so, which includes the one from the representative here, compared to 329 credit unions. And it was that sort of difference, and particularly looking into the future where that sort of difference might lead us, that led David Knott, the Director of Australian Financial Institutions Commission, to make those remarks about the character of credit unions compared to building societies, which you may have read in our submission. And if I may, Chairman, just to briefly quote a few lines from there. He said, speaking to a building... Perhaps
if you could just give us the reference to save time.
Reference to page 5 and 6 of our submission where it's cited, where he referred to the fact that building societies did not have that mutual status which bound together credit unions with cohesion, that instead there was quite a gulf between the different types of building societies. Now, that's not a direct quotation, but members of the committee can read the full quotation on pages 5 to 6 of our submission.
Thank you.
He concluded by saying one can't help contrasting that diversity, that is in relation to building societies, with a very different model which applies in the credit union industry and which, when combined with their concept of common bond, serves to promote a very strong homogeneous sense of identity and shared purpose.
Right, now, I don't think today is helping financial institutions to be all one big happy family, but Mr. Larkey has to respond to Mr. Lachlan responding to Mr. King.
Mr. Lachlan did advise that why didn't XYZ building society convert to a credit union or take advantage of credit union provisions. Indeed, Graham is on record as saying that amongst other things, building societies ought to convert to credit unions to get the tax break, and that's on his record, and that's an inducement for us to convert. And if the Treasurer, Minister representing the Treasurer was here, he could add another couple of $100,000 to the subsidy, $100 million. On this question of the mutual character, we don't have any difficulty or any brook with the credit unions if they want to develop the mutual idea, if they want to distinguish themselves. But really what the question is, they want to be mutual, and they went to other legislations and got themselves banned from raising capital because that was... But they're really asking everybody else to pay for it. They're really asking the taxpayer to permit them to be a mutual. I say, and my colleagues say, they can be a mutual and they can pay tax. And I think their margins and other things relate to that. I was frankly amazed, and I was involved in the building societies approached AFIC on the basis that we were going to have to raise capital. We could not do it on the basis of our after-tax performance in the times provided, and so we looked to other options. You don't have to look for other options if the taxpayer is paying for your capital growth.
But you wouldn't be supporting that some of these very small people that we've heard today should be subject to tax, are you?
No, as I said, Senator, in my very first utterances, I think the church credit unions, we are distinguishing quite clearly between the front runners in the credit union movement and the traditional parish credit unions, of which I'm still actually a member.
That's not what's going to happen, is it?
Can I now, Senator, just a second. Sorry, on this point, or
yes, on this point.
Senator Campbell's been patiently waiting for a question.
Where would you draw the line? Could you give the committee the guidance? What is the criteria that you would use to draw the line between those two types of credit unions?
$500,000, I would think. I don't have statistics below $1 million, but I would think if the parish credit union or that very tight bond, if they had a fund of those sorts of hundreds of thousands of dollars, then they could meet many of the very genuine and hard cases where they can make an unsecured loan to the person, knowing that they live in that community and trusting them to repay it. My view would be $500,000.
Shouldn't a better test what they do, the services they perform, rather than a monetary amount?
Well, that's the dilemma that Senator Woodley was referring to, where you have you either give a tax to a certain style of credit union who are in that business only, or then you're faced with giving the subsidy to the person, which always involves a lot of paperwork and so on in the social security system. But if we are seeking a solution for the parish credit unions, and I think they've got an argument, then I think, unless you want to get involved in all the bureaucracy, an option is, despite what the Senator McMullen said, an option is to draw it at that level to cover those church and that sort of credit unions.
Right.
This worries me a little bit, because this principle could easily extend into other self-help areas, and we could soon find the Sydney City Mission on its op shops suddenly becoming taxable if we allow this principle to on a cut-off sort of figure, because, I mean, by any stretch of the imagination, that is now a big business.
Right, Senator Campbell.
Thank you, Mr Chairman. I wanted to come back to the issue of the common bond, because it sparked something that Peter King said sparked this question. I think it's a core issue, and one of the reasons why we have what is a fairly bitter fight going on between the two forms of institutions, and that is that clearly there is some blurring in the public mind between what credit unions do and what building societies do, and the common bond, I think, is an important thing. And I'm sure Peter King, when you drive around Perth, you hear United Credit phone loan, for example, blaring out of the radios all the time. And I'd be interested for the credit unions to tell me, for example, what is the common bond that an institution like United Credit has, that its members have, because I think it's a core issue. If the common bond becomes so broad, then you begin to, it becomes to be a bit of a rort of the principle of the common bond, and it begins to destroy the credibility. I'm sure there's some credit unions who have a very specific common bond, like teachers or nurses or Qantas pilots or police, exactly. I know that. Those ones are all clear examples that we have home in Western Australia. And also parishes, again, are a case where you have a very clear, distinct, publicly recognisable common bond. And it comes back to the question that we were just discussing there about the parish example, and whether you have a $500,000 cut-off. It really should be a common bond, and if there is a common bond in a parish, for example, the question then comes, well, if you've got a parish and that's a good common bond and that's a good size to have this tax exemption for, then what if you have a very big parish? So you can't have a parish that's less than 500,000. You might have a parish with a very clear common bond that's got capital of 5 million. So how do you do that? But the core of the question is, how do you define the common bond? Specifically, I don't know if there's anyone from United Credit Union here. I'm sure Mr Lachlan might be able to speak on their behalf, but I would like to know, for example, United Credit, who probably spend millions of dollars on Perth radio offering their services to clearly the public. I'd like to know what their common bond is. Is it the people of West? Is the common bond that you're a West Australian with 2 arms and 2 legs?
Perhaps
Senator, if I could attempt to answer that. I don't obviously have the list with me of all the credit unions, and I can't tell you precisely what United Credit Union's common bond is. It's true that some credit unions do have a common bond which is much broader than others. Some of them are extremely specific. As Graham Lachlan mentioned earlier, every common bond must be approved by the particular state regulator, the state supervisory authority. We can certainly get the information to the Committee on United. But if you were to look at that list of 329, you would see simply from the title of the credit unions, whether they referred to a particular parish or a particular employment group, that the vast majority have very specific common bonds.
I do recognise that. The real question is, in the case of United, that's not going to be clear to the public or to many of us as to what the mutuality and what the common bond is between the members of that society. And as I think Senator Watson said earlier, any member of the public could just ring up and say, I want a loan, sort of thing.
Isn't it, even the name in some cases doesn't necessarily indicate that that's the limit on the membership, does it? Or on the ability to make a deposit?
Not necessarily, although in many cases it does, because it's so-and-so employees' credit union. You would find, I think, that over half of the 329 credit unions are employees' credit union.
But what I'm saying is that even if a credit union has the name of a particular group of employees, doesn't mean that investors have to be one of those types of employees to invest.
The law's pretty clear.
Sorry, you're nodding. I'm not sure what that means.
Well, the law says, because we're going to tell you what, I mean, I can't speak for United or any other credit union individually, but I can tell you what the law is, and it's policed, and there are rules for breaking it, as there are anywhere else. And it says this: you can't do business without a member, without the person being a member. You can't do business with a non-member. That means...
Not even accept an investment?
No, there's no such thing as an investment. You can only take a deposit, and the deposit can come only from a member, and a loan can be made only to a member. And indeed, the law says financial transactions. I mean, anything you do, you can do only with a member. That's the first step. Secondly, in relation to credit unions and credit unions only, it says the membership can be drawn only from that group whose eligibility for membership is defined in the rules as approved by the authority, the supervisory authority. Now, it's up to the members of the credit union in general meeting to define the rules that they want for membership eligibility. And some will say, we elect to have very narrow rules. That's their choice. Others will elect to have broader. And I don't deny that the credit union you mentioned would fall in the broadest. But simply because the members themselves have chosen to do so and voted accordingly in the general meeting to have those rules does not automatically mean that they're the rules. They still have to be approved. And the authority who does that has to subject the application for the registration against the criteria which are defined to regulate or administer, his particular regulatory function. And I've no doubt that some get knocked back. And you're quite right to be sort of hypothetical about it. If you walk in and say, it's any person resident in the state of Western Australia who's got 2 arms and 2 legs, then that does not identify a community of interest. There must be a community of interest, and some are broad.
But even if a particular employment group, say police, somebody mentioned before, are you saying that if I've sought to make a deposit with the police credit union and I've never had any connection with the police, that they should knock me back?
That's exactly right.
And if they accept the deposit, they are breaking the law.
Yeah,
you're saying that credit unions like that never accept such deposits?
No, I'm not saying that. I mean, it's not for me to say yay or nay on that. I don't enforce the law. I'm in no position to know. But I am telling you is what the law is and what the credit unions are supposed to do.
So credit unions are supposed to say to me in that situation, are you involved with the police? And if I can't prove that I am, they should say, sorry, we can't do business.
That's right, and not only that, there is an intermediate step. Once you answer the question, yes, I'm a policeman or whatever it might be, I'm a fire brigade man and you want to go to the fire brigade credit union, you then have to execute the appropriate membership procedures. You've got to put your share, it's a withdrawable share, it's not share in the sense of equities that we've been talking about earlier today, but you have to acquire, for consideration, some ownership in the credit union. You've got to jump that hurdle. before you can put in your deposit. This is materially different from the thing we were talking about before, where you can go into another organisation and simply front up to the counter, put $10 in as a deposit, and that ipso facto makes you a member. This is quite a different thing. Now, I can't answer the question about has anybody ever broken the law and does the supervisor police it adequately. Our view is that he does, and I'll finish by saying this. You have to understand there's some internal mechanisms within the credit union movement which work pretty effectively here. For example, the credit union that might look after, if I could just take Senator Campbell's attention for a sec, Ian, the credit union that takes the firemen in Western Australia is going to take a pretty dim view of United or somebody else expanding their bond in a way which poaches or potentially poaches the fireys. So the credit unions themselves keep a pretty careful eye on how everybody else moves their bond because it has implications for their own future. So what I'd suggest to you is there is a pretty effective self-regulatory mechanism here. It's not foolproof, but it's not bad. That's the first hurdle. The second hurdle that the people have to jump is the government one.
Anyway, I guess I just have to say your description of how things should operate is certainly not the impression I've had.
Mr. Chairman, I'd just like to respond to that and to Senator Campbell that with United Credit Union, there's also the Police and Nurses Credit Union, which you would be aware of as well, that are very active. They've got branches throughout the state, and you can walk in off the street and open up an account with the police and nurses, and they do not ask you, are you a police or are you associated with the police or a nurse? That's how easy it is. We did it last week. Now, as far as the question of membership...
Is that a failure of the regulatory regime?
Well, what you don't know is that you don't know where they did have a common bond of, say, only police employees. You don't know whether... I don't know whether they've changed that common bond to include, like probably United, to say anyone living in Western Australia. I don't know.
Anyway, can I suggest that a relation of, say, a policeman or a nurse, in most of the credit unions I would know of, if you're a husband, wife, son, daughter, increases the bond.
It also widens it. It also widens it.
Yeah. Now, yes, you want to make a contribution.
But sorry, Mr. King is saying that you can walk into the street and not have to go through the membership procedures that Mr. Lachlan says are legislated and are...
Yeah, when you open up the account, they ask you to fill in a membership form.
Yeah. I'm telling you what the law is and what I believe is established in common practice.
So the police...
What you're being told here is anecdotal evidence, if it's even that, hearsay, that somebody did it. I don't know whom, when, where, who they are. They need to put their hand up.
We can't keep this particular issue going on all afternoon because I don't think we can advance it any further.
They're breaking the law, but the law's not being enforced.
I'd just like to help.
Yes, can you
clarify?
I don't think we've got evidence of you talking. You identify yourself.
Philip Elliott from the National Credit Union Association. There is some history to this that's very critical, and it is a very critical issue. That is the matter of a common bond. Because the new financial institutions legislation has only been in place for less than 12 months, there are a lot of histrionics here. A credit union like United out of Western Australia operated under a legislative environment similar to, say, Tasmania, where the legislation was so antiquated that it didn't require that the rules included a common bond. Notwithstanding that, 90% of the credit unions in those states adopted a very realistic common bond, so that you did have aberrations such as that occurring. Now, it came up to the 30th of June last year when the new legislation was passed and implemented with its historic common bond, which was a very broad one. I did have some contact with it a number of years ago, and it was being invited, as its name suggests, to provide services to employees in a variety of factories. And so they came up to one corner of the street, and then people would be wanting to join the credit union because they had no other credit union facilities available. So it tended to expand, and that's the basis of the name United. So there is a history to how that evolved and developed. However, two important points to finish off on are that I believe the State Supervisory Authority in Western Australia will have to come to grips with that situation, because the legislation does say there must be a common bond within the credit union rules, and I believe United Credit Union will have to come to grips with that as well. As for some of the anecdotal statements as to certain people just walking in and so on, can offer no comment there other than that if those people do not fall within the common bond, then there is a breach of the rules occurring.
So does Tasmania still have the antiquated
No, they
legislation?
came under the National Uniform Code. What happened under this AFIC, the Australian Financial Institutions Commission, from 1st July last year, all credit unions, irrespective of which state they are registered in and trade in, are subjected to the same legislation.
Which requires the common bond?
Yes.
Senator Kemp.
Thank you, Mr Chairman. Of course, the issue which is transfixing us all is the differences between the building societies and the credit unions. Where is the common ground? Where is the difference? And I'm not too sure whether my mind is clearer as a result of these hearings, to be quite frank. But Mr. Lee, just before we resume today, you brought to my attention some other arguments on the level playing field. And I think this again will perhaps widen the sort of debate a little bit. Would you like to sort of make those comments to the committee? I think that would be assistance.
I would certainly like to. Unfortunately, this issue has devolved to a slanging match between us, and is obviously starting to confuse and muddy the issues rather than help clarify them. But my concern is that the debate is being carried at too narrow a focus. It is a much broader issue. I've been involved with credit unions now for just over 20 years and have seen credit unions go through a lot of battles with a lot of different organisations and governmental agencies in this country. And when the Campbell inquiry started, thought that there may be a level playing field coming up in the future. And that was over a decade ago, and the level playing field, much vaunted at that stage, is getting further and further out of sight. And in fact, if this current tax status of credit unions was to be removed, that level playing field, so far as credit unions are concerned, would get even further out of sight. We can list 8 or 9 major benefits that the banks have got, not the least of which is concessions of a taxation revenue nature conferred upon the banks within the last 3 months by the federal government that exceed, in a per annum basis, $250 million. So part of that concession is for foreign banks, part is to try and induce banks to help small business. Credit unions have been helping small business for many, many years now.
Those concessions don't necessarily apply across the board to all banks. I think you're referring to overseas banking units, aren't you?
Well, part of it can be an
Which is a
inducement.
pretty restrictive thing because they don't operate across the Australian residential sector.
Yeah.
So I mean, when we're talking about taxation concessions applying to banks, we're talking about institutions which are taking overseas funds. They're not taking residents' deposits.
No, I'm not talking about where they get their deposits from. I'm talking
But
about
when you're talking about concessions, I mean, we're not talking about the same thing. We're talking about a very specialised banking service that has a purpose. I'm talking about OBUs that has a very restrictive application, and it's because of the nature of where they take their deposits and how they apply them that they get this special treatment. But in no way would OBUs compete with credit unions, building societies or ordinary banks.
Senator Watson, there's an interesting angle to this, though.
So, I mean,
what Philip's talking about is the...
I'm a bit worried that you're trying to bluff us with science.
No, sorry. Having heard what you said, I made 2 references there. The first was reputed to be, by the Treasurer's own paper, worth around $100 million per annum, and that was the one that does have application to overseas banks.
That's right. So that's irrelevant to the discussion today.
Well, no, the second part of it, $140 million worth, is just simply the increase in the rate being paid to the banks on their non-callable deposits.
That is right.
So there's $140 million there, but that's...
but that's part of the prudential...
Can I make General Watson, can I make a couple of points on those?
Mr. Lachlan, and then who's calling it here? Mr. Jack.
Notwithstanding that the first of those, which is the partial exemption of interest withholding tax, relates only to the foreign banks. And your point on that is correct. Can I make this point about both of those matters? And the second one, by the way, is a revenue matter. It's not just a prudential matter. The fact of the matter is if the Reserve Bank, under government policy, did not pay $140 million more to all banks in the form of interest on their non-callable deposits, then it would be paying $140 million more in Reserve Bank dividends to the revenue. So it is effectively a tax measure. But the point about those two that's really most interesting is this. We don't knock either of them if they have a good social purpose. They illustrate that the government is prepared to use tax policy to achieve desirable social objectives. In the first, it is to assist foreign banks get funds into Australia which will help Australia become a foreign platform for banking in the Southeast Asian region. And the second is to ostensibly help small business lending. All we're saying is, for precisely the same reason, the government could agree to continue to leave the credit union taxation in place, because that also is an adjustment to tax policy to produce a desirable social objective. Now, in relation to credit unions, the government's case is to say, no, we can't do that. Tax neutrality insists upon us not doing that, and that's what's in the explanatory memorandum.
Well, I'll accept that argument.
Right, thanks.
Not the other one.
Now, did you want to respond, Mr. Larkey?
Mr. Chairman, I think there were 8 points to make. I think you've only got to one.
Well, obviously struck a raw nerve. But, essentially,
but not the first time, did I?
And essentially what I was wanting to do was broaden the scope of the view of this debate. If we're going to talk about what's fair and equitable as between financial institutions, then I believe that the debate must be broadened to that level. Otherwise, we're just picking off one item in isolation and saying if we remove that, then all's going to be fair. And simply that's not the case. The banks in this country totally control the issue of cheques. Graham Loughlin's mentioned that a few times today. It is a major concern to both building societies and ourselves. We have to organise arrangements with banks to in fact be able to issue cheques in this country.
But there is some talk about that changing, is there not?
Yes, that may occur. The legislation has to be amended at the federal level. We are totally unaware of any bill. There's discussions to some extent.
And the same as the payments exchange, you can. That's right. You're going to be in that as a primary player before long.
If certain steps that we understand may occur do occur, but at the moment, no, we can't. And for the last 20 years,
that might be one of our recommendations. It's up to you to convince us.
Trustee status, which confers a large amount of money to the banks and to the building societies. Most building societies have trustee status. Credit unions have never had it. Taxation concessions, which are the two items I referred to before. Lender of last resort facility from the bank, and the perception in the minds of the Australian community that the banks are guaranteed by the government, and that is the case with most people in the street. The banks have complete access to fixed capital, share capital raisings, and that's something that we do not have, that has been a little confused today, but I'd like to come back on that one later on. But that's where they can get their capital from. Their profit performance determines how well they do in that area.
Could I just interrupt on the guarantee? As I understand it, the credit unions in a way sort of act as self-guarantee, because if one goes has a bit of a problem because of some individual being involved with fraud or whatever, the national movement bolsters that particular organisation.
Yes, we have
large contingency.
We pay for it.
And we had to pay for it.
Yes.
We have it's been at our behest over the last couple of decades that's come into place. We've even had to work very hard for up to 5 years with various state governments to get them to agree to provide for that in the legislation. And all it was to put a safety net in place that would achieve our objectives. And those funds are still in place, and we still receive no revenue in relation to them. And that brings me to the next point, that the banks basically pay nothing towards the cost of their supervision. We have these contingency funds that are still in place. The credit unions get no dividend in terms of an interest return on. And we also have to pay right out the cheque, as with the building societies, for our supervision. So if we want to talk about equality in the playing field, from pre the Campbell inquiry, it's just getting further and further away so far as credit unions are concerned. And in relation to credit unions, cannot stress more strongly that because we cannot issue fixed capital, and because we don't want to, because that destroys the member-owned mutual concept, we believe that any alternative to that is what we will continue to pursue. and the mutual status and the varied tax treatment for mutual organisations as opposed to private entrepreneurial capitalised organisations is one of the fundamental issues here today.
Yeah, just a second. With Dr. Boxall in terms of the banks not paying anything.
Yeah, can I just while he's thinking about that, Mr. Taylor was trying to say something now. You have something different to say from Mr. Elliott?
Related
Are we about to see the difference in within the credit union organisations?
No, not at all, not at all. In fact, I'll keep my comments brief because much of what I was going to say has been said by Philip Elliott. Rather, I'd just like to make the general point that it is unfortunate that so much focus has been placed on the building society versus credit union characteristics. We've been forced to do that in a sense because of the way the debate's gone prior to today and today. But our preference, and as was evidenced in our first submission that many of you may have seen, was to acknowledge that this is a concession. We know it's a tax concession, but we asked those making policy to put up against that the benefits that the community accrues from that concession, and also to bear in mind many of these disadvantages that credit unions face, not only against building societies in some areas, but more primarily against banks and against the other finance aspects of the finance sector. So it certainly wasn't our intention, and it's still not our intention, to focus solely on this building society comparison.
Right, now Mr. Hope wanted to intervene on this matter.
As a very small player in this whole big sea, it seems to me that there are two things that I think Mr. Elliott and Mr. Taylor just alluded to, that there is a moral issue in there as well. And we talk about level playing fields and everything else. It just seems to me that, and a comment from Mr. Ahern was that I could have saved my members, even though I didn't work there at the time, $400,000 had I become a credit union some years ago. But that would have meant then, I think, that I would have cost my country $400,000. And if someone can, afford to pay tax, why shouldn't they? That's really what I feel is the crux of the issue.
Okay, now, Dr. Boxall...
I'd like Mr. Boxall to comment.
Well, all your members have got hands.
Senator Watson just wanted to check with you whether the information that was stated about the differences in who pays what for supervision and so on.
The statement was made that banks don't effectively pay anything for their supervision. Is that technically a correct statement in terms of their statutory reserve ratios and that sort of thing?
It's not in my area, Senator Watson, but it's my understanding that the banks don't pay an explicit fee for supervision.
But they lodge funds, don't they, with the Reserve Bank at very low or nominal interest?
They pay an implicit fee. There's an implicit cost, but it's my understanding that they don't pay an explicit fee. But the issue is that the supervision of credit unions and building societies is an issue for AFIC and the Reserve Bank, and it's basically a state issue.
Could I make a comment about that, Mr. Chairman?
Yes, I'd be interested in your, given your involvement with both sides, I'd be interested in your...
My understanding, though, is that the implicit cost of supervision as a result of the variation in payments made by the Reserve Bank are in the order of 5 basis points. For the financial institution industry, the supervision cost is 50% higher than that, at about 7.5 basis points. I might say there's a potential slight variation in that upwards, so it could be as much as 8 basis points, so it is a little higher.
Sorry, Mr. Larkin.
Just to comment on Mr. Elliott's comments, we don't have any disagreement with the points that he's made. I don't think some of them are relevant to the issue, but all the burdens and costs that he was referring to, we meet those as well. There is an issue there, but we have to pay for them and pay tax as well. And that comes to the pressure on us and the disciplines on us to cut our other costs so we can pay those costs.
Mr. Chairman, can I have a question again to Mr. Boxall or Mr. Lachlan? I think you raised it, Mr. Lachlan. You referred to the exemption of credit unions in the UK and the USA. I ask, what's the tax position of building societies, particularly the smaller building societies in both of those countries? Can somebody tell me?
The taxing for building societies there is a concession on the interest that's earned in a building society in the UK.
Sorry?
There's a tax concession on interest for building society interest in the UK. Now, what it is the credit unions, I don't...
And you don't enjoy that here?
No.
I understand the Canadian government has recently changed its policy in respect of taxation of credit unions. That's what I heard in the media recently, that in fact they are taxing credit unions in Canada or are proposing to.
What I'm saying, is there anything in overseas legislation, particularly the UK or the USA, whether it is by way of tax concession or special treatment of interest, that virtually brings back the building societies to a level playing field somewhat to the exemptions provided to credit unions? That's what I'm interested in.
Well, I don't know what the taxation position is for building societies in the UK, and of course there are very few building societies. No, I shouldn't say that.
That's not
what are called building societies in America, which are savings and loans, are often not in good shape to pay tax, even if it's levied on them. I don't know what the situation is in either country. I just know what it is with relation to credit unions, and it's the same as it is here.
Well, the tax office, or tell us?
Sorry, Senator. In the UK and Ireland, the situation